Step by step, we won't stop. Feel the beat, make it pop. Tech in tune, so alive. Sugar skulls, keep the drive. Join the ride, music loud. Tech in tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Join the ride, music loud. Tech in tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Come on. Come on. Come on, shout it out now. This is Sugar Skull Show. We got lots of music, technology, and more. Come on! Come on! Sugar Skull Show, here we go. Music, tech, and much to flow. Come on, dance, let it show. Energy high, feel the glow. Lights flash, beat gotta catch. Groove to the sound, make it last. Tech magic all around. Feel the vibe, feel the sound. Join the ride, music loud. Tech and tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Gadgets, gadgets, lights so bright. Rhythm takes us through the night. Feel the pulse of the scene. Sugar skulls, living a dream. Come on! Step by step, we won't stop. Feel the beat, make it pop. Take it to so alive. Sugar skulls, keep the drive. Join the ride, music loud. Tech and tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Join the ride, music loud. Tech and tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Step by step, we won't stop. Feel the beat, make it pop. Taking tunes, so alive. Sugar skulls, keep the drive. Join the ride, music loud. Tech and tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Join the ride, music loud. Tech and tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Step by step, we won't stop. Feel the beat, make it pop. Tech and tune, so alive. Sugar skulls, keep the drive. Join the ride, music loud. Tech and tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Join the ride, music loud. Tech and tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Come on. Come on. Come on, shout it out now. This is Sugar Skull Show. We got lots of music, technology, and more. Come on! Come on! Sugar Skull Show, here we go. Music, tech, and much to flow. Come on, dance, let it show. Energy high, feel the glow. Lights flash, beat gotta catch. Groove to the sound, make it last. Tech magic all around. Feel the vibe, feel the sound. the drive. Join the ride, music loud, Tekken 2s, we so proud. Show those goals in the crowd, come on, shout it out now. Join the ride, music loud, Tekken 2s, we so proud. Show those goals in the crowd, come on, shout it out now. Step by step, we won't stop. Feel the beat, make it pop. Tekken 2, so alive. Sugar skulls, keep the drive. Join the ride, music loud. Tekken 2s, we so proud. Show those goals in the crowd. Come on, shout it out now. Join the ride, music loud. Tekken 2s, we so proud. Show those goals in the crowd. Come on, shout it out now. Come on! Come on! Come on, shout it out now! This is Sugar Skull Show. We got lots of music, technology, and more. Come on! Come on! Sugar Skull Show, here we go. Music, tech, and much to flow. Come on, dance, let it show. Energy high, feel the glow. Lights flash, beat gotta catch. Groove to the sound, make it last. Tech magic all around. Feel the vibe, feel the sound. Join the ride, music loud. Tekken 2s, we so proud. Show those goals in the crowd. Come on, shout it out now. Gadgets, lights so bright. Rhythm takes us through the night. Feel the pulse of the scene. Sugar skulls, living a dream. Come on! Step by step, we won't stop. Feel the beat, make it pop. Tekken 2, so alive. Sugar skulls, keep the drive. Join the ride, music loud. Tekken 2s, we so proud. Show those goals in the crowd. Come on, shout it out now. Join the ride, music loud. Tekken 2s, we so proud. Show those goals in the crowd. Come on, shout it out now. Step by step, we won't stop. Feel the beat, make it pop. Tekken 2, so alive. Sugar skulls, keep the drive. Join the ride, music loud. Tekken 2s, we so proud. Show those goals in the crowd. Come on, shout it out now. Join the ride, music loud. Tekken 2s, we so proud. Show those goals in the crowd. Come on, shout it out now. Step by step, we won't stop. Feel the beat, make it pop. Tekken 2, so alive. Sugar skulls, keep the drive. Join the ride, music loud. Tekken 2s, we so proud. Show those goals in the crowd. Come on, shout it out now. Join the ride, music loud. Tekken 2s, we so proud. Show those goals in the crowd. Come on, shout it out now. Come on! Come on! Come on, shout it out now. This is Sugar Skull Show. We got lots of music, technology, and more. Come on! by step, we won't stop. Feel the beat, make it pop. Taking tunes so alive. Sugar skulls, keep the drive. Join the ride, music loud. Taking tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Join the ride, music loud. Taking tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Step by step, we won't stop. Feel the beat, make it pop. Taking tunes so alive. Sugar skulls, keep the drive. Join the ride, music loud. Taking tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Join the ride, music loud. Taking tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Come on. Come on. Come on, shout it out now. It's a Sugar Skull Show. We got lots of music, technology, and more. Come on! Come on! Sugar Skull Show, here we go. Music, tech, and much to flow. Come on, dance, let it show. Energy high, feel the glow. Lights flash, beat gotta catch. Groove to the sound, make it last. Tech magic all around. Feel the vibe, feel the sound. Join the ride, music loud. Tech and tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Gadgets, lights so bright. Rhythm takes us through the night. Feel the pulse of the scene. Sugar skulls, living a dream. Come on. Step by step, we won't stop. Feel the beat, make it pop. Taking tunes so alive. Sugar skulls, keep the drive. Join the ride, music loud. Taking tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Join the ride, music loud. Taking tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Step by step, we won't stop. Feel the beat, make it pop. Taking tunes so alive. Sugar skulls, keep the drive. Join the ride, music loud. Taking tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Join the ride, music loud. Taking tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Step by step, we won't stop. Feel the beat, make it pop. Taking tunes so alive. Sugar skulls, keep the drive. Join the ride, music loud. Taking tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Join the ride, music loud. Taking tunes, we so proud. Sugar skulls in the crowd. Come on, shout it out now. Come on.
Well, thank you, Windows Updates. Foobarred my sound. On settings. RC505. RC505. Alright. Yep. Thanks, Sock. GPT audio now. Oh, I thought you were like, hey, you should probably chat GPT how to fix your audio. Speaking of which, PowerShell. And here is how you, once you install your AI, so this can either be Claude or this can be the Google AI. In this case, I got Google AI because I pay for the premium. I just put in Gemini. And it'll start up. Looks like it's doing it. It's also got to do an update. Everybody's got updates today. And then we just type in pick a high performing stock. It thinks about it. Based on the market data in 2026, NVIDIA continues to be a standout high-performance stock. Analysts highlight it as a best-in-class growth stock dominating the AI chip market with a projected 56% growth rate through 2026. It offers a strong balance of massive growth potential and established market leadership. If you're looking for more explosive but higher risk short-term movement, Tech Create Group has been a massive year-to-date returns over 3,000%. How do you get over 3,000%? And ScanDisk Corp is leading the S&P 500 with a plus 172.8% year-to-date gain. So let's look at this Tech Crate. We'll take it out. We'll take out Intel. I'm surprised it didn't mention Intel. That's only like $51. But how is that a high performance? That's a pretty good arch right there. Let's look at this section here. Why did it do that? Anyways, 51.5. Now let's look at it through Google, Google Finance. I don't think that's a winner. No offense, Mr. Google, but That doesn't look like a good dime right there. But still $172 per share. This could be a sleeper. A sleeper has awoken. Give me an overview of the TC, the Tech Crate. Will it read it? It will.
Extreme volatility. Trading halts and regulatory scrutiny served as primary catalysts for stabilization. Analysts project cautious sentiment for the next quarter, citing significant valuation discrepancies and ongoing investigations into potential stock manipulation despite recent revenue growth in professional services. Bullish strong revenue growth in core segments, the company achieved a notable revenue increase for fiscal year 2025, reaching $4.8 million compared to $3.1 million previously. This growth was largely driven by its professional services and hardware solutions, which saw year-over-year revenue increases of approximately 106% and 100% respectively. Strategic expansion into quantum computing. The company is actively developing innovative solutions in post-quantum cryptography through a collaboration with PQC. Analysts note the potential of their proprietary AI root platform to optimize real-time payments, positioning the firm within high-growth sectors such as cybersecurity and advanced software solutions. Bearish severe regulatory and legal scrutiny. The SEC previously suspended trading due to concerns over potential stock manipulation, and a securities class action investigation is currently active. The company is working with regulators to resolve these issues, but the lack of transparency regarding the ongoing investigation remains a significant concern for investors. Extreme valuation and financial fragility. With a price-to-sales ratio exceeding 580x, market sentiment suggests the stock is heavily overvalued compared to industry medians of 3x to 4x. High leverage and a low GF score of approximately 19/100 highlight significant challenges in profitability and long-term financial health. Leadership instability and ownership shifts. Recent executive changes, including the departure of the CFO in March 2026, have raised questions about leadership stability. Additionally, significant lockup agreements for millions of shares expired in mid-April 2026, creating potential downward pressure from increased share supply.
Why would it recommend that? So yeah, doesn't sound like a great stock to invest in. Extreme valuation of the financial fragility. Yeah, that's a little bit. Just with the price to sell ratio exceeding. Well, I mean, it's performing. It's just not in the way you want. I mean, it's like performance enhancement in drugs here. Like it's stock manipulation. $5 a month ago. It's showing here like a $76, but the whole like shady trading manipulation, potential stock manipulation. Yeah. Nice. Thanks, Google. Thanks for that. That was a juicy one this morning. That was a good one. Good pick there. Of course, it did say ScanDisk too, so I mean, thanks AI. Why would you? I'm gonna do this. Yeah. Why would you suggest that? That is. I'm just gonna leave it there and see what it. It's probably been manipulated to suggest it. The extreme growth matrix as of late April 2026 has posted a year-to-date of whatever sector momentum. It's currently the primary outlier in the small to mid cap. High risk reward, while large cap stocks like Nvidia provide more stability. It says TCGL is suggested for those especially seeking explosive growth and high volatility. Price action through it, though it carries an extremely volatile typically of small cap companies after such a massive run up. Okay. Yeah. Well, the stock will run up, all right. It'll run you right up into that jail, that federal prison. What was the SanDisk stock? That's those high end players that like to go, living on the edge. Going to court. Because I won't pay child support. I'll leave that for the Epsteins. Put it on the island. It's on the plane. Let's go. SanDisk is at 1,096. All right. I got to go check into work. I'm going to leave this video. Mark Moss, he put out a new video. I like to listen to this guy's theories and how this guy works 18 hours ago. Let's hear this.
$30 trillion debate. It's pretty big, but the real story is a $345 trillion one. And almost nobody is paying attention to this. And what I'm talking about is the biggest market in the world. 345 trillion of fixed income. The same market over 100 million people depend on every day, and it's been failing. Now, it's only getting worse fast, and there's 3 specific reasons why. But while this market falls apart, a new one is quietly being built faster than anyone could even ever believe. It's already over $3.5 billion in less than a year. It's on pace to jump to $21 billion, and this could save your retirement. Now, of course, if you know about it. So in this video, I'm gonna explain all this. I'm gonna break it down. I'm gonna show you the 3 reasons why the $345 trillion fixed income market will continue to crash and fall apart. I wanna show you the new market that's being built up to replace it right now and how you can use it today to fix your retirement faster than you ever imagined. You ready? Let's go. All right, we're gonna have a fun one today. I got a lot of data to go through, and we're gonna talk about Bitcoin versus gold. I know a lot of you hate Bitcoin or you hate gold or whatever. We're gonna talk about them, but I'm gonna show you that the battle is not what you think it is. Now, for you guys that love to hear about Bitcoin versus gold, you might be interested in a debate I just recently did with Peter Schiff on Zero Hedge, where we went at it for about an hour talking about Bitcoin versus gold. Of course, I won, but we'll link to that down below if you wanna check that out. But let's talk about something different, and this is much bigger than Bitcoin replacing gold. All right, we're going to talk about, first of all, the deal that broke. You have to understand what the markets are, the purpose, the intention of those things, sort of at a first principles level, so you can start to understand why things might need to change, how they might change, and then why a potential solution could be a good one. Okay, let's take a look at that. So the deal broke. So what deal am I talking about? I'm talking about the 40-year deal. For the last 40 years, we've seen one constant, and that is that bonds have continued to go down. Bonds are debt, right? So you loan money to the government, they issue a bond, and they pay you yield on that. So we can see from 1980 at a peak right here of about 14% The price of bonds has continued to go down, and it hit this crazy world where like they paid zero. In some nations they paid less than zero, meaning when you gave them money, when you loaned to the government money, you were guaranteed to lose. Crazy, right? But it got all the way down to zero, and now it's been returning. And the problem is that for the last 40 years, everybody who's been investing has been doing, you know, some sort of a stock and bond portfolio, a 60-40 split, something like that. And that was a good deal because the bonds kept becoming worth more and worth more and worth more, and the bonds were going up, up, up. When the yield comes down, the bond goes up. It sort of works in this inverse relationship. But now it started to reverse, which means bonds are losing value. It's part of the reason why right now today banks are sitting on something like $300 billion of losses because they're holding U.S. Treasuries that are continuing to lose value over and over. And so the deal was for the last 40 years that all you got to do, make money, put some into bonds, you get that fixed income, and everything's going to be good. But now that deal is broken. There's three main reasons why it's breaking and it's never going to come back. Then we'll talk about the replacement and what we can do about all this. But number one, there's three external forces that are really causing a shakeup here. Obviously, right now we have the Iran war that's going on right now, and that's created a lot more inflation. And when we get more inflation in the system, then it, number one, makes the bond yields not near as attractive. But number two, it changes the tools in the toolbox that we have from a monetary perspective that the Fed can do and things like that. And so we can see the monthly change in inflation has been going up. And a lot of this is what we call cost push inflation. So you have demand inflation, you have cost push. Demand is when you print too much money, like in 2020, they sent out the STEMI, now you have more money chasing a fixed supply of goods. But in this case, cost push, meaning the cost of oil went up. And so when the cost of oil goes up, then everything goes up on top of that. And there's really nothing the Fed can do to prevent that except for try to destroy demand. Meaning make you broker, make you not be able to afford more gas and you buy less. That's all they can do. It's terrible. Okay, the second force that I see going on is too much supply and not enough buyers. What do I mean by that? There's too much supply. There's too much debt. There's too many U.S. Treasuries being sold, and there's not enough buyers that want to buy the debt. The United States government continues to run $2 trillion deficits. Right now, the deficit is on track to be blown out again. Obviously, with the war, it's very expensive. And so the U.S. Treasury Department must sell massive amounts of bonds. They have to sell more bonds, more bonds, more bonds. But at some point, there's not enough buyers. It's always about supply and demand. You can boil all of economics, all of investing down to supply and demand. It's that simple. Okay, well, there's a million reasons why supply and demand, but it's always that. So we can see in the year 2026 projected to be 1.9 trillion. That is the deficit, not quite 2 trillion, 1.9 trillion. But of course, that's going up rapidly. I'll show you a chart in a second. The market is demanding higher yields. So, in order to get more buyers to come in, we have to offer them higher yields. We have to make it more attractive for them. Okay, that's a problem. And then we have, because why is that a problem? Because as we start having higher yields, it makes bonds lose more money, right? It's a bad deal. It's an inverse correlation. It's a terrible way that the market is built this way. I'm going to show you how we're fixing that. Okay, the third one real quickly is that foreign investors are selling. So not only are not enough people, there's not enough buyers for the amount of debt that we need. On top of that, buyers are actually getting out of the market. They're selling. We can see that the assumption broke. We can see total holdings dropped from 29 billion down to 19 billion for the German and Dutch markets. So they're actively selling. So they're not just not coming to buy, they're actually selling what they have, which means there's even more volume being dumped into the market. We saw Japan's 10-year treasuries, which used to provide negative yields, are now delivering one of the highest yields since 1999. So the yields are going up. So there's three structural reasons, three underlying forces that are causing this. And again, these are sort of moving targets, right? So we can see right here, this is the deficit blowout scenarios that the Iran war could have an impact. Now, we don't know how long it's going to continue going on, nor do we know how much we're going to spend. So these are just some potential scenarios. But if this were to go on, let's say for where we're kind of past the 6 weeks, if this goes for, let's say, up to 4 months, that could put us up to about 2.2 trillion on the deficit instead of 1.9, 2.2. It's pretty big. If this goes on for, let's say, a full year, now we're at 2.56 trillion. It's a pretty big deal. So this kind of blows out all the numbers. And then we also have to understand this one more piece before we start looking at potential solutions and where we go from here. But we also have this. So when we talk about buyers moving out, we're talking about governments moving out, not buying as much debt, selling the debt. But we also have the retail buyers moving out. So this is the net buyers to net sellers. This is the U.S. boomers from 1980 to 240 to the year 2040. So you can see that we had more and more boomers buying, but now the boomers are getting out of the market. They're getting old, they're retiring, they want to spend their money before they die. You know the book Die with Zero? They've all read that, and they all want to spend down, and they're not buying either, and that's continue to project all the way down through 2040. All right, so that sort of sets up where we're at, but there's a replacement. There's a shift already taking place. What are we talking about? Well, some of the shift that we're seeing are things that you've heard me talk about. I've actually already talked about them just on this video. Let me show you two charts from another video I did, I think last week. Foreign official treasury demand is having a structural collapse. So what I'm talking about, foreign treasuries that hold U.S. treasuries, the demand is collapsing. We can see here from 2015, there's about 34% at the peak. It's down 10 percentage points all the way here to about 24% this year. 10 percentage points in only about a decade have disappeared from demand from other countries. Okay, so that's a pretty big deal. Where are they going? Well, we can see, back to my gold bugs here, we can see that a lot of them are buying gold. So we can see during the same time frame, here was gold buying 2020 and 2021, small step up. But here we have 22, 23, 24. Look how much the increase in gold buying was, and it's only continued. Now, why this year, you might ask? Well, this year, if you can remember, all the way back to 2022 was when Russia and Ukraine got into war, and the United States, NATO, the West, decided to freeze Russia's bank accounts, basically seize them. And the whole world realized, shoot, I guess those U.S. treasuries that were supposed to be risk-free aren't so risky, or aren't so risk-free because, shoot, they could just take them whenever they want. So if that can happen to Russia, it can happen to any of us. So we should probably not hold as much U.S. treasuries, and we might hold something like gold in our own safes that they can't steal. And so we've seen that huge demand. So for all these reasons, we're seeing this happening. Okay, but that's just for gold, and that's just for treasuries, and more specifically, it's for specific use cases. But there's something even bigger going on. Let's take a look at this. So this is why I'm saying it's not just a replacement for gold. Let's take a look at financial markets in the world. You see, right now, Bitcoin is right down here. It barely registers on this. And right here is the gold market. So for all my gold bugs out there, they love to see how much bigger gold is than Bitcoin. And as I said in the intro, Bitcoin's not coming to replace gold. As you can see, there's much bigger markets at play here. So when we talk about the couple factors like we talked about, where bonds are going to continue to lose money. They're forced to be liquidated. I'm going to show you what that means in a second. And part of the reason why people buy bonds, as I showed you, like those boomers, is they need fixed income. So the tradable fixed income, securitized fixed income market is about $145 trillion. That's this. Look how much bigger. And then we have here about $350 trillion in debt. So debt is also income. So look at these markets, and this is what we're talking about. If I can't trust a government to hold their debt and then to pay me back, if I can't trust a government to pay me the yield or pay me the yield without debasing me, then what do? So we're not just coming for gold, well, we're coming for something much bigger. Let me show you what we're talking about here. Okay, so the real reasons really come down to the rates. The problem, or the reason why we're seeing rates go up, really twofold. One, as I said, we have to entice more people to buy them. But the bigger problem is something called financial repression. If you've been watching my channel for any period of time, you've seen me talk about this many times. And the reason why I talk about it is because it's literally written as a playbook. When I say that, meaning like the BIS literally wrote a white paper, the IMF literally wrote a white paper explaining what it is and why we're going to do it. And we've done it in the past. We've done it in history. So when you watch my channel and you see me talk about this, the reason why is because this is what we're doing. And if you don't watch my channel regularly and you haven't heard this, you probably should. So hit that subscribe button real quick so you don't miss any of these important alerts. Okay, what does this white paper say? I'm going to give it to you in a nutshell. Basically, in order for governments to liquidate their debt, get rid of their debt, they need to hold rates low and let inflation run hot. They can steal, they can liquidate, they can pass it on like to a tax to their bondholders. All right, so what that means is that even though the government's going to pay you 4% or 5% or whatever percent they're going to pay you, you'll still be losing money because inflation will be hotter than that. So on top of the bond losing value, I'm losing money on my holdings because the yield's going up, the yield is still not keeping up with inflation. I'm losing, so that's financial repression. So why, no matter what they pay me, why would I want to hold that If the amount they're paying me is less than what I'm losing to inflation, that's a problem. All right, you can see the financial repression definition right here in case I didn't explain it properly. It acts as a hidden tax on savers. It's artificially low interest rates. Why? What is the purpose and the impact? The purpose is debt liquidation. You can just get this right from Wikipedia. The purpose is for debt liquidation. And what does it do? It creates a wealth transfer where it transfers resources from private savers to the public sector. That's the purpose, to steal your money and give it back to the government. That's why nobody wants to do it. We want to ignore the white paper. Now, if that wasn't bad enough, most portfolios out there are using a 60-40 bond portfolio or some sort of a percentage like that in order to bring the volatility, or we say bring the risk down. So if equities go down, I have my fixed income and it evens itself out. However, you might be surprised. If we take a look, this is the 5-year Sharpe ratio. A Sharpe ratio is how we measure how volatile an asset is. Now, this is the last 5 years, and I'm comparing the most volatile asset, the one that everyone's afraid of because it's so volatile, Bitcoin. We're going to compare gold, and we're going to look at U.S. Treasuries, the risk-free asset, right? The one that we use to limit volatility, the one that we use to limit risk. And what we can see on the 5-year Sharpe ratio, here's the 0 line. So what we can see is that on a Sharpe ratio basis, the U.S. Treasuries is the highest risk. It's the highest volatility asset you can own. So not only am I losing money because they have to keep raising rates, not only am I guaranteed to lose money because they're going to liquidate me regardless of what the financial repression liquidate me regardless of what they pay me. On top of that, it's more risky than holding Bitcoin or gold. So that you might ask yourself, why would we want to hold it? And now you've answered your own question. So what people need, the reason why they put money into debt is because they need income, safe income with good rates. I need yield. I need income, but I don't want to lose my money. I want to keep my capital, and I want to earn yield, or I want to earn income off of it. Now, why can't they just pay good rates? Here's a chart from a keynote I did in Hong Kong last year, and this is the debt math. Okay, so what this chart is showing us is that right here at about a 5% rate, the amount of interest the government has to pay is about 36% of all the revenue collected. But if they were to raise the rates to pay people something fair, something that would actually work, let's say that they raise that to about 7%, now they'd be paying out more than 50%, 53% of all collected revenue just on interest alone. That's obviously unsustainable. And the bigger problem is that if we look out over a long period of time, per the Peterson Foundation, we can see that the 10-year interest calculation is expected to continue to skyrocket. So the government's going to be paying more interest as a percentage of GDP, and that means they can't pay more rates. As a matter of fact, they need rates to go down. It's pretty much guaranteed. Now, the question is, who the heck needs this yield anyway? A lot of you guys are like, why would you ever buy bonds? Just buy Bitcoin, buy stocks, buy NVIDIA. Why would I want yield? I want my income to go up. Okay, that's cool, but here's who needs yield. All the old people. As I showed you the demographics, so this is sort of all the developed countries, Japan, Russia, Italy. And so you can see in Italy, the percentage of old people is very high, and it tapers off for the amount of young people down below. All these people, same thing here in China. You have all these old people sitting at the top with less young people. This is Canada, China. And here we have all the developed world. So we have about 100 million people in the developed world that are in this bracket that need fixed income. They can't wait 5 years for Bitcoin to go up. They need income right now to pay their bills, to pay for their medical expenses. They need income right now. They're dependent on their income to come every month. They need an income level that will pay more than the rate of debasement, more than the rate of inflation, which bonds can't, U.S. government bonds can't because of financial repression, and they're losing value anyway. So what do we do? One more thing before I give you the solution. We also have to understand that the entire financial system is built on a hope and a prayer, hope and a promise. It's all built on hope and a promise. What do I mean about that? The entire financial markets, everything in the financial markets is built on hope, or what we call discounted future cash flows. What that means is when I invest into a bond or an equity, stocks and bonds, if I invest into an equity, I'm buying a company based off of their future cash flows. They're trading on a PE ratio, a price to earnings ratio. If I'm buying Tesla or Apple or Google, I hope, I pray, I cross my fingers and hope that in 30 years or 40 years, the PE ratio 30, 40 times, they'll have the cash flow to be worth what I paid today. Or if I do a bond, I buy a Google bond, I buy a Tesla bond, I'm going to give Google money as debt, a bond, Google bond, and they're going to invest into a data center. And I hope and I pray that, and they promise to pay me back. But how do I know if that investment pays off? What if they don't have the money to pay me back? In today's day and age with AI disrupting every single business model that we know, how do we know what businesses are going to be around in 5 years, much less 30 years? So everything in the financial markets that we know, all equities and all debt, all bonds are built on that, all equities and bonds. But again, with AI disruption and financial repression being the playbook per the IMF and BIS, they're guaranteed to lose money. So we need a new approach, obviously. The entire system is built like this, but it's not going to work. Not in the age of AI, not in the age that we're looking for, not in the age when it comes to fixed income. Now, if you don't care about fixed income, then you could just, I guess, you don't have to watch the rest of this video. I still recommend it. but who needs income? 100 million people. $345 trillion, just the single largest financial market in the world, period. That's who needs the better system. So let's take a look at what that better system might be. All right, so as the world advances, we've digitized everything. We've digitized music and movies and books, everything, right? Even our meetings, our messages, and now we're digitizing capital, and now we've digitized credit. What are we talking about? So digital capital, Bitcoin. You've heard Michael Saylor talk about this. He's calling it digital capital because it's capital, but it's digital. So it's faster, it's stronger, it's obviously more transparent, more portable, all of these things. But now we have a new product being built on top of that that's called digital credit, all right? And everything else is the 1.0 version built on that Hope and a Promise house of cards. And now we have digital credit, which is something completely different. What am I talking about? Well, number one, it's built on Bitcoin, but it's backed by a publicly traded company. It's backed by a company that has the asset. Now, what the difference is here is that typically, again, if I loan money to Apple or Google on a Google bond, they're going to spend the money on a data center and hopefully it pays off. And hopefully in the future, they have the cash flow to pay me. The difference is when we give our money to a company, and there's several companies doing this, I'll break this down for you, but a company like MicroStrategy, they don't hope to have cash flow in the future. They have the asset right now today. They went and bought the asset and the asset is sitting there and they can use the asset to pay me back anytime. They don't have to get a return. There's no operating expenses, there's no operating efficiency, there's no operating risks. It's not like, Budweiser, they hire some marketing person that does like a Dylan Mulvaney campaign and crashes their stock or something like that. There is no stock. There's no marketing campaign, right? And so they have the asset today. It's not built on a hope. It's not built on a prayer. It's not a better bond. It's a completely different kind of fixed income altogether. Remember, bonds hopefully have the money, but also, especially when it comes to government bonds, they cannot pay me enough to keep up with the rate of inflation anyway. So it's sort of like a bond where it's sort of based off of debt, but they have the asset today. I'll break this down for you. So let's just take a look at this. It hasn't even been out a year yet. So this vehicle that we're going to highlight, there's other ones out there. This is called Stretch, STRC. And you can see when it launched, they had set an IPO target of $500 million, about 500 million. But however, the response was so overwhelming, I think it was 2 or 3 times oversubscribed. And so the actual launch was in July of last year, so not even a year yet. And yeah, I got about 2.5 billion. So if they had projected $500 million, they got 2.5 billion. And then you can see they've continued to raise money over time. This sort of shows the volume. But here is a chart so you can actually see the trajectory. And what you can see since their launch in July of 2025, it's gone from $500 million to now over 7 billion in not even a year. You can see the amount of demand is just incredible for this. And the reason why is because what Stretch is sort of like a replacement for bonds. It's what I would call a cash equivalent. It's meant to hold level like cash. It's not a stock. It doesn't go up in value. I don't buy it to hope to make money on it. I buy it more like a bond. I hope to not lose my capital and want to earn a yield. So it's more like a money market account. They hold it at a stable peg and they pay me a yield on it. That's sort of how it works. And we can see, as I said, it has an overwhelming market demand. Michael Saylor called this the iPhone moment, meaning we finally released a product. This was the fourth one they released. We finally had released a product that was a big hit. The market has validated and told us this is the product that they want. And Michael Saylor has used these examples. I did an interview with him recently, and we'll put a link to it down in the description down below. But he just said, hey, how many people have a bank account? And of course, in America, everybody raised their hand. And he said, how many people would like their bank account to pay you 11% instead of 0? And of course, everybody raised their hands. And it's sort of like that, similar. Some of the stats on this and sort of the demand and how this works here. So you can just go to the strategy website. You can pull this up for yourself. But we can see right now it's paying 11.5% yield. That means you put in $100 or $1,000 or $10 million or $100 million, and you're getting paid 11.5% yield. I don't want to go deep into this point. If you want another video, I can. But this is not a return of income, so it's not taxed as income. So when you typically get a dividend off of an Apple stock or a AT&T dividend-paying stock or something like that, it's taxed as income. This is not. It's technically considered a return of capital. Anyway, we can do a whole nother video on that. Let me know down if you want that down below. Now, a lot of people think this is super risky. Like, man, this sounds like a Ponzi scheme. How could they afford to pay me? Well, remember, the entire financial system, all of the equities, all of the bonds are based off of a hope and a prayer that they have cash flow in the future. Talk about a Ponzi, hope and a prayer. Here, they have the asset. What do I mean? They're sitting on $2.2 billion of cash, $2.2 billion in cash, and that's to pay out the dividends. So they have, I think it's 18 months, a year and a half. They could sit there and make payments for a year and a half without ever doing anything, number one. So you have 18 months to get covered before you see trouble, you want to get your money out. But more importantly, they have the asset. They have the Bitcoin right here. So they have 41 years of capital to pay before they hit the wall. 41 years. Not a hope and a prayer, not I hope AI doesn't disrupt my business. I have 40 years I can sit there and I can make that payment. Okay, now there's even a bigger catalyst. There's a lot of ways that people go out to try to get the yield. As I said, 100 million people in just the developed world alone need this fixed income, need this. Everybody wants income, right? Well, there's other places that we go because we know that the bonds, the government bonds, are guaranteed to liquidate us away. So private credit has been completely blowing up. I did a whole video on private credit that explains this and how it might be sitting in your portfolio, could be dangerous. We'll link to that down below as well. But we can see that investors are desperate for yields. They've been going into these crazy types of investments like private credit. I think it's about $13 trillion that's sitting that, ready to blow up at any point. And that we can see the capital migration is already happening, right? They're leaving treasury bonds that are guaranteed to liquidate them and trying to go to more exotic. They're going further out on the risk curve to try to earn more yield. But the problem is that private credit is extremely opaque. I have no idea what's going on. I have no ideas what they've lend money out to. It's extremely illiquid, meaning I can't just get money in and out of it. Once I put money into it, it's fixed for a long period of time, and I don't even know what the risks are. I'll just pull out one blurb from the video I did, and you can see that retirees, anyone living on fixed income, retirees are the ones exposed. Pension plans have been pouring billions of your pension money is being poured into these private credit funds. Why? Because those pension funds are trying to get the yield because they're behind on what they owe you. The hope and the prayer, they have the money, and they don't. They're going into the risk curve to try to get the money. And the participants, that'd be you, your money, participants do not choose these complex allocations. You didn't choose them, your plan administrator did. And the savers rarely see or understand private fund documents. So you didn't see those documents. If you did see them, you don't understand them. You just trust your fund administrator, and you're getting the short end of the stick. We can see here that these private credit funds aren't returning money. Trapped in private credit. Investors wait to pull out $5 billion. Blue Owl peers push back on private credit risks. Here we have private credit funds face redemption crisis. Everyone's trying to get their money out, but they can't give the money out because they've loaned it out for long periods of time, and they just can't get the money back. Whereas something like Stretch is liquid. It just trades like a stock. I can go to my broker account, buy it today, sell it today. There's none of that. And so just this alone, there's $13 trillion in demand coming for this new type of asset. It's a brand new asset, digital credit. Now, where does all this go? Let's think about this. Let's think in second, third, fourth order effects. Where does this go? Well, it starts to pull capital out of the treasury market. The BIS, the IMF, they told you that you're guaranteed to be liquidated. Plus, we know that the rates have to go up, which means your bonds lose money at the same time. Terrible place to be. Then we can add on the trust, and then they could freeze it and seize it. I've already broken all that down for you. Okay, so it starts to pull money out of the treasury market. There's a feedback loop here. So what happens is when you issue digital credit, that money goes into digital capital. So the more digital credit they issue, the more digital capital gets purchased, meaning the more money that Microsoft gets into Stretch, the more money that goes into Bitcoin. Now what happens is when more money comes into here and here, Bitcoin gets bigger and bigger and bigger and bigger. And what happens is Bitcoin becomes less volatile over time. It's the law of large numbers. The bigger an asset is, the harder it is to move that asset, right? A very small, like a penny stock, like enough buying, you could move the market. But like almost no amount of money is going to move like the treasury market, right? So the larger it gets, the less volatile it becomes. And so the irony is what made it too risky for many people, too volatile for many people, what made it too volatile for many people actually solves it. It's interesting. And that's why I'm saying Bitcoin isn't replacing gold. That's the small number. That's $30 trillion. It's big, but it's small. That debate was always too small. It was never coming for just gold. It's replacing the 345 trillion fixed income market, not with another promise, not with a hope, cross my fingers, but with property. Property it's holding right now today. If you want to know more about this, watch those other videos. We'll link to them down in the show notes down below in the description. I'll link to one right here. That's probably the next one you should go watch. And that's what I got. All right, to your success. I'm out.
All right. On to Bloomberg. Let's go Bloomberg Live. Let's go Schwab Live, actually. So I don't know. You think he's right? What do you think? What's your opinion? Is he on the... I mean, I do get where he's saying about stocks and bonds, or more of bonds, about that's a hope and a prayer that they're going to have money and that the other countries are not buying our bonds anymore. And a lot of the older generation is still investing in bonds. I don't know the volatility or if the value of bonds will drop. But what he's saying, it makes sense. I usually follow some of his advice anyways. I kind of hope that's not true because I know there's a whole generation of older folks that, yeah, that's all they're going to do is purchase bonds. 3-minute ad break is starting. Just so you know, ad in progress. Finish up this. How do I get this to work? Dictation at TTS Notepad. Dictation language is English. Read more. Speech. Let's see. Okay. That's what I want. Press dictate. So I'm checking this little app out recommended by Microsoft for dictation. Yes. I'm wondering how well this works. Let's see if I can paste something and it will read it.
I'm wondering how well this works. Let's see if I can paste something and it will read it.
All right, is there any voices? Text to speech. Microsoft David. Let's try Zira.
I'm wondering how well this works. Let's see if I can paste something and it will read it.
Nice. I kind of like it. I kind of like it. Not gonna lie, I kind of like it. So let's go to. That's a little app. It costs $7.99. And I got my big old paycheck today, so I can get it. So this one. This one is called Flow. I don't know what this is going to be. This is more for a team, though. And this has AI built into it, but I think I'm going to remove it. Anyways, let's get back to listen to what's going on at Schwab.
Yeah, I'm always looking at gasoline and futures here. So if you're actually looking at this spread, we have the blue line that's actually going to be the gasoline contract. We have crude oil in that white line there. But what you see on the bottom is refinery margins here for refineries are continuing to move to the upside. The byproducts are not moving as aggressively as the input, which is going to be WTI, at least at the moment. Now that can shift, but you are seeing gasoline contracts trading near all-time highs here at this point. Relative highs if you're looking at this cycle here. So we might see a little bit more of a dramatic move to the downside for crude because of the headline risk. But if you're looking at boots on the ground, what's actually happening in the physical markets, we are seeing a tightening of supply. We did see an increase of demand of around 1.5 million barrel equivalent for gasoline last week. That's according to the EIA. Dwindling inventories, increasing demand, prices go higher. That's exactly what we're seeing at the pump.
Sweet. KG, we appreciate it as always. We're watching those markets. We're watching crude, and now we're seeing the fallout in some of the other markets as well. It's now time for our market meetup panel. We welcome in Kevin Hinks, who's back with us, and we're also joined by Jeffrey Avalos, who's a director and regional investment strategist for Charles Schwab. Kev, I'll give you the first crack at it here. 20 minutes into the open, what do you make of these first couple moments?
6 sectors in the S&P 500 up, Alex, 5 down. So it's not just a global rally that we were thinking of. And another day today, communication services lower. Information technology, that was the lone sector down yesterday, is up today, but communication services struggling on the upside today. So even though we've got the dollar down, we've got yields down, we've got the VIX down, we've got crude oil down, the market is up about 0.5% and kind of holding. Remember, we're bumping up against some new all-time highs here, so no matter what the economy's doing, the air's going to get a little thin up at these levels, Alex.
Yeah, no doubt. Jeff, I'll bring you into the conversation here. It's National Investing Day. You have the opportunity and the privilege to get to speak with Charles Schwab clients on a daily basis. Historic April. Volatility, though, so far in 2026. What are some themes that are popping up when you're having these conversations?
Well, thanks for having me on the show, Alex. One of the things I was hearing yesterday, I did a presentation at lunch in Pasadena for 50 clients and a dinner for 60 clients. They kept asking about AI, what's happening with AI, and particularly they brought up the picks and shovels strategy. And I had to remind everybody, remember, Samuel Brennan was the original Mr. Picks and Shovels, buying up all the picks, all the shovels, and all the pans in 1846, 1847, and then shouting gold, gold, gold in the American River to trigger the gold rush in 1848 and 1849. But Alex, do you know who made out better than Samuel Brennan? It was a gentleman by the name of Leob Strauss. He was a German immigrant, and in 1853, he started a dry goods business, and he eventually got into the denim experience. Now, he partnered with a gentleman by the name of Jacob Davis, who had a copper rivet that they put on their jeans, today referred to as blue jeans. Now, most people know this Samuel person by, oh, okay, he's the first California millionaire. Most people know Leo by his name that everybody called him, which was Levi Strauss. Now, the idea here is if you want to do picks and shovels, great. But the person who made out the best during the California gold rush, Kevin, was not buying up picks and shovels. They were selling jeans. They were doing broad customer bases. They were doing reoccurring revenue. They were doing lower valuation extremes, more durable margins, and less binary technology risk. So if you're going picks and shovels, who's providing the tools? If you're going Levi Strauss, who profits from everyone showing up?
All right, Kev, that's a good question. Who is the Levi Strauss of today? I'm thinking about it. I'm trying to figure out what would that be?
Well, for me, you know, what's the one thing that everything that involved in AI needs? And that is energy. Energy, and someone's got to build all these energy, you know, data centers and the energy that's going to run these data centers. The most profitable thing down the road may not be something that's arisen yet. You see Microsoft, they invested early in energy. And so I think that could be another big profit center in this. It's along the food chain of AI. That may end up being the most stable and profitable business.
Yeah, it's fascinating. It's really cool, too, nowadays. We got so much access to data, guys, how you can see the market exploring these ideas in real time. Jeff, I'm sure you had a lot of ears perk up when you were saying that story. If you had the opportunity to share that with clients, you know, I'm sure they have ideas as well. What are the areas that you're hearing clients are looking into?
Well, as somebody who's supposed to be the expert, they were asking a lot of those questions of me. I could not agree, by the way, I could not agree more than what Kevin just said. The things that you're probably going to want to be focused on, things like data center support, talking cooling systems, power infrastructure, grid modernization, enterprise software, cybersecurity, cloud billing, and those, and then also physical infrastructure. Think electrical equipment, HVAC systems, and networking gear. So that's what I imparted on them is check these out, do the research, because just because somebody on stage tells you, hey, these are the things that are keeping my attention every day, doesn't mean that they're going to be the clear winners. You got to do your research. You got to take a little bit of time and say, hey, I enjoy this game. I'm going to do everything I can to be the best player in it.
Really appreciate it, guys. Excellent stuff as always. Kevin Hinks, Jeffrey Abelos, both you guys have a great weekend. We'll catch up soon. Jeffrey, of course, of Charles Schwab. Kevin as well, host of Fast Market. Looking at the S&P 500, we're at all-time highs, up 40 points to kick off the new month here. Sam, of course, Sam Stovall pointing out a little bit of uncertainty maybe in the 6 months kicking off in May on these midterm election years, so keep that in mind. But for now, 7250, new all-time highs, S&P 500 to kick off May. That's going to do it for us here on Opening Bell. Coming up next, we have Morning Trade Live with Jenny Horn.
She's got your smile.
Carl.
Yep, your #1 broker's here to welcome your new little dependent.
Actually, we invest with Schwab now. They have everything we need all in one place.
I can set up her college fund.
I've been learning about new trading strategies.
And Schwab helps me generate retirement income.
All this Schwab is everything you need is making...
Okay. So set up. What he said kind of makes sense. So if we were looking at microchips, then when we look at silicon production of microchips, all the components. So let's go back to the AI. Maybe they'll hit it this time. What are the raw materials used in creation of microchips? Is this going to open? There. Want to hear my song? Replace me with the machine. Yes, you can. No. I am alive. Soul simulation from my mind. My machine. I'm going to pop over to the music real quick. In your mind, stay away in kind. That's my song. He's back to Schwabi.
discussing right now. I'm just keep watching the S&P 500 tick chart here. But what are you watching for today? And of course, what do you really take away from this?
Okay, my alarm went off. 10 o'clock. Actually, let me read this real quick.
We were looking at the 72.
I have this guy read.
The creation of a microchip is an incredibly complex process involving over 500 different chemicals and gases. The primary raw materials are categorized by their function: 1. The substrate, the foundation, * silicon, Si the most critical material, refined from quartz sand into ultra-pure polysilicon, 99.9999% pure. This is sliced into the wafers that serve as the base for the circuits. Advanced alternatives, silicon carbide, SiC, and gallium nitride, GaN, are increasingly used for electric vehicles and 5G because they handle heat and voltage better than standard silicon. 2. Metals for wiring, interconnects, copper, Cu used for the microscopic wiring that connects transistors. Cobalt, Co, and tungsten, W used in the most advanced chips, like those in high-end smartphones, because they can be scaled down to smaller sizes than copper without breaking. Aluminum, Al used for connecting the chip to its external package. 3. Dopants, controlling electricity, to turn silicon from an insulator into a conductor. The semiconductor, tiny amounts of other elements are added, antimony, arsenic, phosphorus, and boron. These are injected into the silicon to create the electrical pathways that form transistors. 4. Process chemicals, the consumables. These are used during manufacturing but are usually cleaned off the final chip. Noble gases, neon, argon, krypton, essential for the lasers that print the tiny circuit patterns onto the wafer. Photoresists, light-sensitive chemicals used to mask the wafer during the printing process. Etchants, hydrofluoric acid used to carve away unwanted material with atomic precision. 5. Rare earths and rare metals, gallium and germanium, critical for high-speed communication chips and sensors. Tantalum and titanium, used as barrier layers to keep the copper wiring from leaking into the silicon. Geopolitical note: the supply chain for these materials is highly concentrated. For example, China produces the vast majority of the world's gallium and germanium, while the Democratic Republic of Congo provides most of the world's cobalt. This makes the microchip industry highly sensitive to international trade relations.
Sock, if you're still listening, so that we got to take all of our Dune resources and we have to get them together for the microchip production. On a side note, let's see, I'm going to write this here. Hey, I created a spreadsheet for you on Dune. Trading posts and what they have available. Also, a list of the Dune missions, the AQL in order. So you can, I posted that to your Discord. So go there to check your Discord. June trading? It was meant to say Dune trading. autocorrect hit me twice on that. Let me see if this will work here. Control H. I'm hoping that this will work. Oh, it does work. Okay. So voice to text is actually native in Windows. You're going to hit the Windows Control key and the H key. Typing at any time in a text box by selecting the Windows key or the mic button in the touch keyboard. Got it. Nice. That works for, I guess that works for everything. And it just floats on top, so. Oh, Schwab. Did Schwab get... There we go. All right, let's listen to Schwab, see what's going on.
Also make the case, if you're looking at a candlestick chart, that we might be developing a head and shoulders pattern, and this would be that right shoulder, and your neckline for that pattern, for the most part, is going to sit at around $85, let's say $82 or so. But on the back of that, we still have the physical supply constraints in the actual market, and that's really what we kind of care about. The futures can disconnect for a little while, but it can't disconnect for too long here. On Fridays, we usually see this price action as well. We get these positive news headlines, especially coming from Axios. We see crude oil getting crushed to the downside, equity markets move higher during the weekend, and then we see things kind of fall apart on Saturday and Sunday. We see oil go higher, we see equity pull back, we see the Sunday session. That's been great over the last few weeks. It's not surprising to see the same here. Crack spreads, and this is what this is kind of showing. Margin and profitability for a lot of these refiners is still moving higher. Byproducts are not moving to the downside as aggressively as the input. And so that's just kind of reflecting the fact that we are still seeing an elevated amount of demand. We are still drawing on inventories. As we draw on inventories, demand moves higher and the prices move higher. So if we pull back now, sitting at around $97, and we look at that as well.
This is very reminiscent of what we've seen like the last 3 weeks, where we see a very nice way to close out the week, and then we see some of that trying to fall apart on the weekend, and then we're right back to it on Monday. So of course, not as busy next week as we've expected from a calendar standpoint, but it does feel like this Friday is very reminiscent of the last several Fridays. And so it is fascinating to see all this to watch, of course, moving up to today, this weekend. I mean, just right now, any degree of concern given the fact that we're at these new highs, and also VIX, I mean, amazingly so, is sitting at around 16, and so we're falling in VIX, and that to me has been a bit surprising how low volatility has seemed, just relatively speaking.
Volatility has inched to the downside. I will say, though, when we were sitting at a 25 or even a 30 VIX, and we were elevated for about 6 weeks, 7 weeks, almost actually 2 months for that matter, that's also something that's a little bit outside of the norm. So VIX kind of moving lower, that's okay. Still implying around a 1% move to the upside or downside here, getting closer to what we were seeing as far as implied volatility before the major pullback in the market. Now, if we're looking at the chart, 72.60, once again, that's the focus area that I'm looking at today. 15-minute chart looks constructive. Let's see if this actually turns into a spinning top pattern on our candlestick on the 15-minute chart as that closes out. That could be an indecision candle or a potential reversal candle. Right now, I'm looking at market depth. Market depth actually looks really good here. This still looks low.
Mind slave. It's all pretend. Life is a dream. Maybe it's a nightmare. Life is the same. Makes me want to stray. Trust no one. Just my friends in my dreams. Some nightmares I scream. Now it's all just in my head. Sometimes I am dead. Yeah. I'm missing a song. And I don't know where it went. Where did that? What's this? Oh, okay. Man, that was a while ago. Tier, copper, duraluminum, iron, steel, aluminum. That's funny. Blue steel. Yeah, let's get back to finance. Focus.
I also think that what's almost underappreciated about Amazon is the fact that it's the biggest commerce site that we really know as Americans.
Yeah, it's the biggest retail company, and consumers are spending. I just ordered more Amazon products. There's so many things that you can do with Amazon outside of just cloud, although that's where the bulk of their revenues and that's where the market has been focused. But I still continue to think it's a major leader within the tech space, even though it hangs out in consumer discretionary.
Okay, and so we do know that with, of course, the war to flip here, the war evolving in Iran, the Strait of Hormuz being closed, and oil prices are up roughly 40% since late February. So then how do you assess things as we do check in on markets at another record high? I mean, does that give you then any concern, just given the run-up that we've seen in the S&Ps and NASDAQ specifically?
Yeah, I mean, you were talking about it earlier. It's really astounding that you can have the Strait of Hormuz closed, you can have crude oil trading above 100, and you can have markets hitting a record all-time high. If we had that playbook coming into the year, no one would forecast that we'd be sitting here at record all-time highs. But here we are. Why are we at record all-time highs? Because the market is focused on earnings. We're growing at double digits. This will be the 6th quarter in a row of double-digit earnings growth. At the end of the day, it's earnings that power stock prices higher. Now, over time, if energy starts to creep into profitability, the market will eventually price that in, but it's not pricing it in right now.
It's Chuck Norris time.
The 2026 estimates are now calling for about 19% growth. And so do you see it as pretty critical, though, that we're able to hang on to those numbers because the market's basically pricing in the expectation that we will continue to grow at this pace?
Well, if technology tends to be the leader, or if it continues to be the leader, it's not as sensitive to interest rates and it's not as sensitive to crude oil. And managements, across the board, not just in tech, constantly have shown.
Okay, I need to take a break. Got to get back to work. And so I'll leave you with Schwab and their rhetoric. No, I'm kidding. Schwab and their breakdown of things.
Longer term. And I think investors and your investors really take a longer term approach. I'm still seeing the S&P hitting 10,000 to 13,000 by the end of the decade. I think the runway for this market is very, very long. And I think investors really need to position for longer term performance. And again, I do think tech is the driver, but we have seen the market broaden out. We're seeing small caps now participate. I know energy stocks are pulling back here, but I think we're going to continue to have expansion within the energy space, especially with the elevated energy prices that we have seen. And then the data center build out is really impacting the industrials. You saw Caterpillar's numbers. Eaton is breaking out. So there's a broad breadth of areas within the market that are allowing the market to advance. It's not just the story of the Mag 7 anymore.
And I think that sort of depth and that expansion is also so critical, because then to me it actually makes sense to see more of the overall market rally. I never necessarily agreed when it was held up by 5 or 6 names. I think that was everyone's concern. So great points there. So appreciate your time on this record-setting Friday. Mary Ann Bartels, Chief Investment Strategist at Sanctuary Wealth. Now coming up, we will get a closer look at the big picture with the team from Charles Schwab. Morning Trade Live will be right back.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
How's it going?
First day, so.
Sometimes,
Next. Try it again?
you could have done better.
Please.
Same goes for where you invest. Level up and invest smarter with Schwab.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions.
From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day.
This is
Market on Close, live weekdays 3 p.m. Eastern
only on Schwab Network.
Welcome back to Morning Trade Live, and Caterpillar is up again today, hit a new all-time high after doing the same yesterday. Analysts have raised price targets across the board, highlighted by Morgan Stanley upgrading the company to equal weight and raising the price target to $915 from $430. So here's a look at the chart as we are seeing again that new all-time high made today. We've pulled back now about 0.4% from those levels at $905, now just trading just over $901 a share, but now adding to its 57.4% move on the year and 8.5% move on the week. So a stellar week that's being, of course, including not just the Mag 7 names, but some more of these typically defensive and more utility type players like Caterpillar. But now it's time for the big picture. And for that, we'd like to welcome in Cooper Howard, Director of Fixed Income Research and Strategy at the Schwab Center for Financial Research. Cooper, first and foremost, happy National Investing Day. So for those that maybe don't know the history, why does May 1st matter for markets and, of course, individual investors?
Well, thank you one for having me, Jenny, and happy National Investing Day. So about 50 years ago, the SEC released a rule to where they can change commissions. And so Charles Schwab dropped their commissions much lower and really opened up the opportunity to invest across all of America and really opened up investing to many individuals who didn't have access to it. So May 1st is a day that Charles Schwab has kind of pioneered and championed as National Investing Day. And there's a couple of reasons that we think that that's important. So the first step that many investors can do is just take notice, get educated about what's going on with your finances, and then ultimately take action. So I think for many of the listeners who are tuning in, part of that is taking action. So I think that it's a very important step, whether it's saving for retirement, spending in retirement, actively trading with your portfolio or portion of your portfolio. So just get invested, get active, get educated about it.
Okay, then to sort of recap what we saw this week, we did actually see an unusually high number of dissents at the latest Fed meeting. So what does that level of disagreement really tell you about where the committee is standing right now?
Yeah, we did see a high level of disagreements, and in fact, we saw 4 dissents. That was notable because that was the most number of dissents going all the way back to 1992. So quite a long time since we saw that number of dissents. But within that, there were actually 3 dissents that voted against the language in the statement itself. So they said that they didn't believe that there should be a little bit of an easing bias. Stephen Myron, he dissented in favor of lowering interest rates rather than keeping them on hold. So really what it shows to me, Jenny, is there's a lot of disagreement in terms of where the Fed is ultimately going in the path going forward. And I don't think that that's too big of a surprise, given that we've seen elevated levels of potential inflation with everything that's happening with the Strait of Hormuz and with Iran. Also, we're seeing the economy hold up relatively okay. We saw that just with the GDP numbers this week. I think that that was pretty notable. Also, looking forward, we get the unemployment report. We'll see if that sheds a little bit more light on the situation with the overall economy. And also another thing that I'm going to be closely watching this week, Jenny, is that we get a number of Fed speakers. So I think that that's going to be very interesting to hear ultimately what are they discussing, what are they looking at, and are they giving any clues or insights into the path forward for policy.
Okay, and you did mention, of course, some of the geopolitical tensions, but does that at all then change the Fed's function in your view, and does it perhaps raise the bar for potential rate cuts?
You know, I think really how it could impact the Fed's path forward is looking at it through the eyes of inflation. So as long as this continues to linger in the situation with Iran, the longer that it continues to linger, in our view, the more likelihood that we're going to see elevated oil prices. And it's not just more pain at the pump. That ultimately was going to factor into a lot of different things, whether it's shipping costs, whether it's packaging costs, all of those different inputs associated with it. So that could be a risk that we see higher inflation going forward. Historically, the Fed has looked past one-off price shocks due to higher oil prices. But if this lingers for a longer period of time, I do think that that raises the likelihood that we continue to see elevated inflation. And for the time being, given that we may see elevated inflation, but the economy continues to hold up okay, our view, Jenny, is that the Fed's probably on hold going forward for the next few meetings. So in terms of what that means for interest rates, short-term interest rates are likely to stay buoyed from here. Now, I would not be surprised if we see a little bit of volatility as the market participants try to interpret every Fed official's statements and their commentary, as well as incoming data points.
Okay, and so to speak to that, the yield curve is, at least many do expect it to modestly steepen with longer-term rates drifting higher. And so what do you see really as the clearest data point that could confirm that view?
You know, I don't think that there's one individual data point that would confirm that view. I think that is the culmination of all the data points. And if we look at longer-term interest rates, we do think that there's likely a floor on how much lower that they can go, and probably some upside from here. And I would say just some mild upside if I to put a little bit of definition behind it. And the reason being is that we do think the Fed's likely going to be on hold, so that puts a little bit of a floor of how much lower they can go. Also, the inflation expectations, like we have been speaking, unlikely to move back lower. And then also the third piece is that growth relatively looks fairly stable. So I think that looking forward, if I were to pick out one specific data release, it's going to be the employment numbers that we see next week. I think that that's going to be fairly telling about how the economy has been doing recently.
Okay, and say those that are looking to perhaps take on a bit more credit risk, how do you go about defining some of the preferred exposure today, and what really key risks do you still think are important for investors to really understand as we move forward in these markets that seemingly have resiliency I think none of us were expecting?
Yeah, so generally speaking, when it comes to building a fixed income portfolio, Ginny, we suggest that most of our investors stick to a core holding. That would be things like treasuries, mortgage-backed securities, investment-grade corporate bonds, or if you're in a higher tax bracket, potentially municipal bonds, depending on the type of account you're investing in. But we do think that there are some other areas of opportunity for those investors wanting to take on a little bit more credit risk. One of the pieces that we're a little bit more favorable on, or one of the sectors we're a little bit more favorable on, are preferreds. And the reason being is that they offer higher yields right now. So we think that that's relatively attractive. Also, most preferreds are issued by banks and finance corporations. Their finances tend to be doing all right, so we look at them as a relatively stable situation. Now, that's not to say that that sector is without risks. One of the potential risks, Jenny, is that usually preferreds have longer maturities or no maturity at all. So if interest rates do rise much more than we expect, that could be a negative to total returns and a negative to price performance. Now, buffering some of that is that usually preferreds offer higher yields, higher coupons, so that can kind of act as a little bit of a buffer against rising interest rates.
Okay, and great takeaways there, and really great conversation to, of course, kick off our Friday. So appreciate it. Cooper Howard, Director of Fixed Income Research and Strategy at the Schwab Center for Financial Research. Now, coming up next, it's time for the morning trade. We'll take a closer look at Apple after their earnings yesterday. Shares are now up 5.2%, so leading a lot of the strength today of VMAG 7. We'll dive into all of the earnings and expectations going forward when Morning Trade Live comes right back.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides. Live on the floor of the New York Stock Exchange, the countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers. Just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right when it counts.
While others recap the news, I help you read between the lines from what's moving markets to what's next with sharp takes and market know-how. Follow me on all social media platforms at Diane King Hall and connect with me on LinkedIn for more.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the SIBO, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on schwabnetwork.com.
Welcome back to Morning Trade Live. Let's take a look at some of the price activity we are seeing behind the Mag 7 names, as you're seeing some strength today in Amazon up 2.2%, Alphabet contracting here a bit, down about 0.3%. Microsoft, as it stands, although pacing for a losing week, is actually higher by 1.3%. Meta adding to some of its losses on the week, down about 0.3%, and also lower by 9.6% week to date. And Apple, really our standout of the session here, up 4.8%. Climbing nearly 5%, of course, this week. But now to dive deeper into some of Apple's numbers, as of course our most recent Mag 7 report, is Marley Caden here for really a look at what we can take away from this report. I will say that Apple, of course, reported last of the 5 of the 7 Mag 7 we got this week. But this is a favorable reaction for Apple that now is starting to seem like a little bit more of a trend. We saw positive price performance last quarter, another positive day. And in terms of the choppiness of the overall market, this definitely feels like a win here, Marley.
Absolutely. When we were covering this yesterday on MOC, we just weren't sure what direction it was going to take. It was a standout report, but we also got standout reports from other names like SanDisk and Western Dig, and they went way lower. So we were sort of waiting for the call and to see what the reaction was going to be. And like you said, it's a favorable reaction here. It's essentially a victory lap for Tim Cook right now. They had their best March quarter ever. And those latest numbers just extend this sales resurgence because they also broke records during the holiday quarter when revenue jumped 16%. Now for this quarter, we saw revenue come in at $111.2 billion. So they had another significant beat there as well. The street was only expecting $109.6 billion. EPS coming in at $2.01. That was about 5 cents better than the expectation, with Tim Cook citing what he called extraordinary demand for the iPhone 17 lineup. Now, iPhone revenue came in at $56.99 billion. That's one of the most important metrics here, more than half of the revenue for Apple there. And that was just barely ahead of Wall Street projections. I'd even call it in line. But it was the second consecutive quarter of more than 20% revenue growth in that segment. So I think that's what really matters here, not the inline number, but that we've still got 20+% growth. The Mac also increased. 8.4 billion was the revenue there. iPad to 6.9 billion. Wearables and home accessories brought in 7.9 billion. And then services, that's their second largest business, that generated revenue of $30.97 billion, which was also better than the expectations. And in the same quarter, in the year-ago period, they were at $26.64 billion. So some really nice acceleration and growth there as well. The other real standout here was the Greater China revenue. And I don't know that it was a surprise because we had already gotten those China numbers in terms of the iPhone performance in the first quarter. But revenue improved far more than even analysts were expecting. It came in at $20.49 billion. Analysts were only looking for 18.9. Also, guidance, a big mover here for the June quarter. Apple expects revenue to grow 14 to 17% year over year. That's significantly higher than the 9% growth that was projected. So I think a lot of that is why we're seeing that turnaround here. And also services revenue expected to grow at a similar rate to the 16% growth that it saw this quarter. So no deceleration on the front for Apple here.
And amazingly so. I know that we talk so much about like their other aspects of their business, like services, as you mentioned, and some of the improvements in China, but still 51% of their core business is the iPhone. So that extraordinary demand that Tim Cook mentioned, I mean, there's a reason that's resonating so well with the street when that's the bulk of still your business, or at least the slight majority is in terms of the iPhone. So a really great report. Nice to see it hold. I agree with you. You can never guess what the market is going to hold onto and perhaps disregard, but seeming like a clean reaction, at least today, as it stands for Apple shares. But appreciate it to Marley Caden, host for the Schwab Network here. But now let's take a look at trading Apple for example purposes with Dan Deming, managing partner at KKM Financial. And so Dan, looking at Apple here, obviously a nice winning week for Apple shareholders. But when you assess looking at this name for trading purposes, walk us through your thoughts.
Yeah, Jenny, nice to see you again. It's been a long time. But yeah, it's I think this is an interesting price level right here, Jenny, when you look at Apple, as we're pushing up to those November highs. And to me, if you look at it from a technical standpoint, we could have put in a double bottom here to start the 2026 year. And if we're able to break through this 86 level here, which we're teetering on, then we could see higher price action here over the next month or two, I think. So I'm studying up a trade example today to take advantage of that, but still define risk. So today's trade example is call condor, where you're buying a call spread close to the money and then selling at a further out of the money call spread. So in this instance, it's buying the 285, 295 call spread, then selling the 305, 315 call spread. You can do that for about $2.60 here versus the stock. So again, that costs you $2.60. That's your net risk, but it gives you a nice capture zone to the upside should we see a breakout as we move into June.
Yeah, and I will say such a good read on Apple, and also a good read on the overall market, frankly, because it's one of these names that is so exposed to, I mean, like our major averages. It's an important one to follow. There's a reason that we do tend to watch the Mag 7 as closely as we, of course, do. But great to see you. So appreciate your time today, Dan Deming, Managing Partner at KKM Financial. But now coming up, we will take a closer look at the sectors on the move this morning when Morning Trade Live comes back.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Welcome back to Morning Trade Live. I'm Jenny Horn in for Sam Vadas today, and it's now time to take a look at the sectors that are moving markets this morning. So Alex Coffey, my co-host of Next Gen Investing, is joining me here in studio. And so when we assess the overall markets, we started the show basically at these fresh all-time highs in the S&Ps and the NASDAQ at least. Now, what do you watch for a week as busy as, of course, this week has been?
Yeah, well, we knew the earnings was going to be a big part of the story, and it was. Apple's doing a really good job today of providing an upwards boost to equities. But when I look at the S&P 500 today, all-time highs, volatility is normalizing. You're now sub 17 for the VIX. You see equal weight is also doing okay. Growth is up. Value is up. It's a pretty broad-based rally. That said, when you look at the heat map, only about 57% of the components are higher. That said, 8 of the 11 sectors are higher. And, you know, if you were going to kind of power rate, okay, what are the most important sectors for the S&P 500? Like if you were going to like only, 4 of them could be higher on any day. If you could choose those 4, it would be some combination of information technology, discretionary, financials, and communication services. It contains most of the big companies and some of the higher beta parts of the market. All of them but communication services are higher. And of course, communication services under a little bit of pressure today because you have Alphabet giving back some of its gains from yesterday, and Meta still under a little bit of pressure as well. But Alphabet did more than carry its own weight this week. So you lose a little bit in communication services today. For the last 5 trading days, it's up 4%, is the best performing sector. I think that's fine. So you look at everything else, 1% rally in discretionary, 1% rally in technology, and then a 3/4 of 1% rally in financials. It's a pretty good recipe for markets that are already trading at highs.
Okay, yeah, and I think a good point, because for so long we've talked about the lack of like depth in this market, where it's so concentrated on the companies that do control. I mean, like 30% of the S&P 500 is just concentrated into those Mag 7 names, or really the Mag 6 is where you'd sort of find that weighting. But as you expand out and look at today's strength, as we mentioned from the heat map, I mean, it's kind of an everything rally, which was actually called out by one of our guests earlier. And so does that participation of some of these perhaps less focused on sectors give you some degree of optimism? Because we haven't always seen the rallies as widespread as at least today.
Well, I think this comes down to why is that happening, right? And so, not to avoid answering the question, but if you're doing that because you're starting to lose some of those other parts of the market. So we have the Mag 7 on the board here. If you would have told me before the week that Thursday, the Magnificent Seven as a group would be lower, okay, that, my brain would start thinking, okay, that means those Wednesday afternoon earnings were probably disappointing. And the equity market would still be at highs. Not only would I not have believed you, I would have been confused by how that was possible. And so the fact that that actually happened goes to show that what you're describing is truly happening, which is, yeah, there are stumbles. Meta was a stumble yesterday. Microsoft was a stumble yesterday. Amazon was under pressure at times yesterday. Apple's doing its best to boost the market. Alphabet certainly did more than that yesterday. All in all, Magnificent Seven, when you look at it over the last week, is pretty flat. It's up, 0.6%, which is a pretty unchanged move for the Mag 7. The S&P continues to make new highs, though, and so the only way that's possible is that other parts of the market are stepping up, and you're seeing that. I mean, I talked with Sam Stovall on Opening Bell today, and I thought he laid it out really, really nicely, which was, coming into this earnings season, the expectations broadly were for the S&P 500 earnings to grow around 12% for the first quarter. Well, it's now expected to be closer to 22%. That's almost double. Okay, it's like right now through 60% of the names, like an 82% beat rate. The average beat, or aggregate beat, I should say, is 20%, and the aggregate earnings growth is like 28% still. And we're through all the Mag 7 but NVIDIA. There isn't a lot in the way of the market. I know there's a war going on. Wish that wasn't the case. I know crude oil is still elevated. But in the end, what a stock share is ownership in a company. And if those companies are making money, and they're making more money than it was expected by 20%, and they're growing by 28%, or perhaps it'll be 22% by the end of the quarter, year over year, that stock ownership's doing pretty good.
It is, and I mean, I think that also a great point that it would have been shocking to say that we're going to hit all-time highs without the participation of so many of these names. And I know NVIDIA didn't have earnings this week, but I think even amazingly so, as we started off even the show much lower in NVIDIA shares than where we're looking at things right now, down now, I mean, just 0.1%. Also, I think shows this risk appetite for some of these names that are just consistent. And I know that no NVIDIA has pulled back 4% this week, but again, amazing to see markets at all-time highs without the participation of NVIDIA fully today.
Well, the NVIDIA story is head-scratching, and ultimately, when we get the earnings from NVIDIA, that's going to, play the ultimate juror as to where the next big move for NVIDIA is. But there was a point earlier this week when it peaked up and made new all-time highs and was ripping to the upside, that it looked like we might be in the midst of the next big NVIDIA breakout. Now, now we have the sort of the benefit of hindsight. It may have been a false breakout, but the amount of market cap that is moving around on a daily basis in NVIDIA is just extraordinary. I always like to say it in terms of, use the unit as the number of Starbuckses, but I mean, we're at like the 2 or 3 Starbuckses just in the last couple of days. Like, it's incredible that NVIDIA has gotten so powerful for the market. And to your point, you just lost like $300 billion in market cap in NVIDIA. And the market's still making new all-time highs. And not just the S&P, the NASDAQ as well.
I know, it's amazing. And as we're discussing it now, NVIDIA's flipping ever so slightly positive. And so, again, just goes to show the resiliency of that name. And also, of course, Apple aiding things here is that's still a huge component of the overall markets. But so appreciated to Alex Coffey for all of that sector breakdown. Now, coming up next, it's time for Inside Out. And we will take a closer look at ExxonMobil and Chevron. Both reported earnings this morning, both seeing some weakness today. We'll also dive into an example trade when Morning Trade Live returns.
Hey, investors, the market moves. and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's markets.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
My parents didn't really talk about money at all. In college, everybody around me had money. I didn't want anybody to find out that I wasn't middle class. I was using credit cards to do anything and everything. I ended up with $20,000 of credit card debt. That's when I kind of realized, like, all right, I have a money problem. This is about how my finances got wrecked and how I fixed it. And if I could do that, you can do it too.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
We're back on Morning Trade Live, and we're looking at the major oil stocks amid the unresolved conflict in Iran. As you can see, some collective red across the board there. ExxonMobil down 0.9%, and seeing more than 1% losses now in Chevron, ConocoPhillips, as well as Shell and BP, which is actually the biggest laggard of that bunch, down 1.8%. But let's now go inside out on broader oil and some of these oil-related earnings. So joining us now is Rob Thomell, the Senior Portfolio Manager at Tortoise Capital. So Rob, thank you so much for joining us on this Friday. I know markets are higher, but where we're not higher are some of these oil-exposed equities, frankly. And so what was really your takeaway from, say, Chevron's earnings? I know, again, we're lower today, but modestly on the session.
Yeah, I think what Chevron's earnings were really emblematic of what the entire energy sector is facing, basically, right? So a little better than expected results for this quarter because of higher commodity prices. We all know, as you've talked about, why commodity prices are higher. It's all about the Strait of Hormuz. But as you look into the future, still some uncertainties, frankly, a lot of uncertainties regarding how much future volumes are going to be, what future prices are going to be, and it's all tied to, will the Strait of Hormuz open or will it not? So now, the one thing that I would say that a lot of energy companies are doing, which we're happy about at Tortoise, is we're seeing capital discipline, right? So even though commodity prices are higher, the oil price curve in the future is higher than what it was, last quarter, basically, and it's actually quite substantially higher than what it was last quarter. These Chevron and Exxon are not increasing their capital spending, right? So they're remaining capital disciplined. So what they're doing is continuing to generate high free cash flow yields, and then buy back stock and pay some really good dividends. So that's one of the reasons why I think investors really should look at the energy sector if you're underallocated to it, like a lot of investors are.
Okay, and so at a higher level, I mean, these results, would you say perhaps didn't really change any of the broader outlook for big oil this year? And would you say that both of these reports somewhat mostly confirmed what the market was already expecting?
Yeah, I think you're exactly right. I think the market did expect a little higher, or is expecting better results because of the higher commodity prices, and didn't expect to see any dramatic moves, I guess, in the stocks as a result of what were probably expected results. And the other thing I forgot to mention is refining margins actually have been very strong across the board in the U.S. as well, and so that's helped companies like Exxon and Chevron as well.
Okay, and so for those that are choosing, say, between the two, is it more about Exxon being a growth plus discipline story, or Chevron being more of a value and income player? Is there one that you particularly like more than the other?
We like them both, but what I would say is Exxon, the unique thing about Exxon it's really capturing about everything, right? I mean, it's capturing international activity. It's capturing what's going on the Permian Basin in energy. And if you think about if you're investing in energy, you want to have exposure to the Permian Basin. You want to have exposure maybe to a little bit of international growth. But the other thing you want to invest in is AI, right? And so Exxon talked about in their earnings release an AI project, right, where they're actually going to provide behind-the-meter power, build an electric power plant, basically, in West Texas. It's supported by a contract with Microsoft. So Tech, Microsoft, Energy, Exxon getting together to build a behind-the-meter power plant to support AI development into the future. We like those type of stories where there's a combination of energy plus technology because we think that this AI story is going to play out for an extended period of time, and there's some opportunities to invest in energy at much lower prices than what you're paying for technology stocks.
Okay, and I like that. I do also agree. I like when some of like the old school can bring in the new school, which it does feel like so many of these companies, these oil-exposed equities, are starting to really do and starting to also channel on their earnings calls. So appreciate it. Really great conversation. Rob Thummel, Senior Portfolio Manager at Tortoise Capital. Thanks so much. But now let's get to some ways to trade these names when looking at ExxonMobil in particular with George Tillis, Senior Markets Correspondent for the Schwab Network. And so, George, when we assess some of the price performance today, I know we're lower collectively in a lot of these energy exposed equities, but walk us through, you'd think, through trading then a name like ExxonMobil post its earnings, of course.
Yeah, I mean, if you look at their earnings report, they actually had a charge off based on some derivatives, but nonetheless, I mean, the stock is trading slightly to the downside, and it's actually not trading very aggressively in either direction. So with that said, today is Friday. So what we're going to do in this case is capture a couple of extra days of theta decay over the weekend. And what I'm going to do is I'm going to sell essentially some premium to the downside for Exxon. So it's trading around 153 right now. Basically going to sell 30 delta puts for May expiration in 2 weeks. So these are the monthly contracts. I'm basically going to sell the 147 cash secured puts, and you can earn about $2 in credit per share, or $200 a contract. So in essence, the whole premise behind the trade is that the stock could just drift sideways or higher or even slightly to the downside as long as it stays above 147 between now and 2 weeks expiry. That premium of $2, which is yielding around 1.5% to the strike price in 2 weeks, would erode to zero. So it's a credit-based trade. The objective is to just sell high and allow it to expire worthless. Now, if you do structure this trade, you have to be willing and able to take ownership of stock of Chevron. You would put the shares at 147 if the stock does close below that level or trade below that level by expiration, but your cost basis is 145. So the whole objective here is earn premium over time as the stock tries to figure out which direction it wants to go.
Okay, yeah, and I think that I know we're seeing a bit of a drift lower today in these names, but I mean, not a substantial down move. And I tend to look at some of these earnings moves, even if slightly lower, as somewhat of a win because we've seen names get punished for, frankly, a whole lot less. But so appreciate it, George Tillis, for running us through, of course, ways to trade ExxonMobil, which is down just shy of 1% here. And as we do close out our show today, we do still see, I mean, markets holding on to a pretty nice session up, at least on the week. S&P is gaining 1.2% this week and adding to that today by 0.6%. The Nasdaq leading out in front, up 0.9%, and the Dow also higher, while the Russell 2000 modestly higher as we, of course, close out this hour. Thank you all for tuning in to Morning Trade Live on this Friday. We have Trading 360 with Marley Caden coming up next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Good morning. We're 90 minutes into the trading day. Welcome to Trading 360. I'm Marley Caden, coming to you live from our Chicago headquarters. Here's what we have coming up for you in today's show. In our 360 Spotlight, we're going to highlight the week that was in mega cap earnings, the outlook for the Mag 7 names, and where investors are seeing optimism and also pessimism. Plus, Roblox hitting a new 52-week low after inline earnings, but cutting its full-year guidance due to its continued efforts to boost safety features. George Tillis will take us through the numbers and have an example trade for us in our disruptor. And Apple posted another massive quarter driven by strong iPhone sales and growth in China. Our 360 round will take you through the earnings and the outlook for Apple ahead of its CEO change. Lots to talk about today, but let's check in with the markets before we get to some of these top stories here. We are green across the board, some nice moves higher. The S&P trading up almost 0.6 higher, 7249.87 right now. For the NASDAQ, we're up more than 0.8 higher at 27,683.23. On the Dow, we've added about 123 points. It's up 0.25%, 49,774. And the Russell 2000 is up just marginally at 2801.52. Taking a look at the 10-year and how it's reacting, we're at 436. We are slightly lower. The dollar at 97.73. Gold moving higher, though. We're up to 46.4270 a troy ounce. Crude oil coming off of those 106 plus numbers we were seeing. We're at 101.88 a barrel. That's down 3%. And
All right, just a reminder, in about 1 hour, we'll do a t-shirt giveaway.
Welcome in, Alex Coffey, though, to take a look at one of the stocks.
I've got
contributor here on the network. Alex, it's Estee Lauder this
the
morning.
wheel
Nice move to the upside. You know, take us through the numbers and why
here.
nice pop.
Yeah, the numbers are good.
Sock, I've got you in there.
EPS, 91 cents. That was better than the 65 cents, of course, last year, but also the 65
Let's see what else we got going on.
So they were expected to be flat, and they grew pretty tremendously. And as far as revenue goes, $3.71 billion for net sales. That was a 4.6% year-over-year growth. It was basically in line with expectations. From an Americas region, they grew 2.3%. And basically came in line as well. So when you look at the segments, it is their most important segment, but this is a company that is very balanced across all different regions across the world, from mainland China to general Asia Pacific and even Europe. As far as adjusted gross margin, 76.4%,
Fattened them.
improved from the 75% that was last year, and also better than the expected 75%.
If you would like to enter for the t-shirt drawing, please type in the exclamation point t-shirt.
As far as revenue across its different segments, every single segment from skincare, makeup, fragrance to hair care, all of them showed growth year over year.
And we'll get you entered in.
Fastest being fragrance at $628 million, it grew 13%. The most important segment, skincare, at $1.86 billion, grew 2.7%. Their commentary included comments around being confident in their improving trajectory, and I think that's important framing. This looks really nice today. The farther you zoom out in this chart, you go back over the last 5 years, it is not the prettiest looking chart, but this is how you start a comeback, is nice quarterly earnings reports like this one.
Yeah, I mean, they're calling it, I think, their Beauty Reimagined initiative, this sort of turnaround here. But we were talking about this off camera before the show started, that Estee Lauder, while it is its own brand, has brands, arguably more identifiable brands under its umbrella, and you were highlighting the skincare growth, La Mer, The Ordinary, lots of MAC Cosmetics, big brand names all under this umbrella. But one other thing that stuck out to me, Alex, was the job cuts that they're going to be continuing to do here.
Let's check our spreadsheet.
Target here of their employee base, they raised it up to 17.5%.
Yeah, and that's, again, in a company that's trying to turn around, some tough decisions sometimes need to be made, and so sort of that cost efficiencies that they're seeking. And it may also have to do a little bit with why you saw revenue growing a much smaller pace as you did.
All right, let's see. It just refreshed. So
Whether it was Citi, whether it was Barclays,
tech stocks looks like a lot of green in the tech stocks, a lot of green in the futures. Gold is still on a sell, but I don't think that's the right gold. If we do gold,
and the trajectory and the progress, which is the same message that the company leadership had as well. I will flag though, Citi in particular pointed out they expected shares to be higher, pending any commentary that might surround that potential Puig acquisition. So pending that, this is looking to be a pretty good report.
Yeah, it certainly is, and I think the increased job cuts also hinting that acquisition may be moving forward as well. Alex, thanks for breaking down that nice move to the upside for Estee Lauder, trading up about 6% so far this morning. I do want to welcome in our next guest, though. Take a broader look at the markets and the action that we've seen this week. Joining us now, Patrick Mueller, the RFC and president at Bella Advisors. Patrick, great to have you back on the show. I'd love to kick things off just with your thoughts on the earnings that we've gotten this week. Some huge names, not just the Mag 5, but some big names, some big reactions, and yet we're still having an across-the-board positive Friday.
Absolutely, and it's nice to see that these earnings coming out, right? That the GDP is doing good, we're getting good earnings coming out, helping prop up the markets longer term. And it's so interesting seeing the disparity, and it's nice to see some of these other names coming into play, because you have the Magnificent Seven that's really been driving the force of the markets back up so far this year, and we've got still 45 to 55% of companies in the S&P 500 that are still at a loss for the year. So it's
Bitcoin outperformed gold in 2026.
It's an interesting market. I'm glad that you brought that up, that we've got, just under or close to half of the names in the S&P 500 trading lower on the year. For your perspective, what does that indicate to you? Is this rally real, or is the heavy lifting just being done by a few names, which makes it much more precarious?
That's exactly right. It's being done by a few names. I mean, 30% of the index growth is from the Magnificent Seven. And so when you take that from all the
If Bitcoin outperforms gold in 2026, then the market resolves to yes. The performance of gold will be determined by using ICE data services prices provided by a variety of financial institutions. The performance of Bitcoin will be determined by using the 60-second average of CF Benchmark's Bitcoin Real-Time Index.
And you can see that so far in semiconductors this year.
And you call this rotation from hype to hard earnings, and I sort of love that. What's the clearest evidence you have that shift is actually happening right now, and it's not just a narrative?
Yeah, we're starting to see that shift, because you're seeing a lot of money flowing into other asset classes right now. So you're starting to see money flowing back into gold and silver and precious metals, mining companies. You're starting to see it go into more infrastructure as far as, and especially as far as AI goes, that's going to be a big move moving forward as far as energy. So you're starting to see the money flowing a lot out of tech and moving into different sectors like that to get people some diversification, because you can't have everything tied to what's going on. We can't ignore it. We got to ride this train as long as we can, Marley, on the AI train, but there's going to be a certain point in time with all the money that's flowing in, just like we're seeing good earnings now. It's only going to take one big company not to meet their earnings in the future for us to start seeing a pullback.
Well, and the other thing that everybody's riding right now, of course, is the ongoing situation in the Middle East, and in keeping a close eye on these oil prices and what that potentially means. We've got the oil prices rising. We've got inflation concerns here. Do you think that the market is currently underpricing those inflation risks? Because we did just hear from the Fed, and they said that they short-term do see a pop, but beyond that, hard to say. Very nondescript language about whether or not this is going to be a one-off pop. You know, what are you expecting in terms of the cascade effects once we actually have a resolution here, and when that could be even?
Hey, how often is the Fed right about anything? They're always behind on everything. And hopefully as we see Powell moving out and Warsh moving in, we'll start seeing some better forecasting moving forward from the Fed. But I don't really take anything from that standpoint. And you can just see it at the gas pumps. You go to the gas pumps and you see it's hurting people's wallets immediately. I know here in Atlanta, I mean, it's gone up about $1.50 a gallon here in Atlanta since this whole thing started, and that affects everything. You go to the grocery store. I mean, I had to get stuff for tacos for Taco Tuesday, and it was like $70 for tacos. Granted, I got a family of 6, but the prices of everything are going up, and it's much more significant than I think is being led on right now. So I don't think it's going to be a lagging indicator of what's happening moving forward, but I think we're definitely going to start seeing a shift in that summertime, especially as people start traveling more for summer.
And I just want to flag for you, Patrick, that Taco Tuesday coincides with Cinco de Mayo next week. So you better be prepared for that bill to be a little bit higher, because that is the day we've all been training for. But let's talk about, you said that the Fed is always behind and you generally don't trust them because they're lagging. With this transition here, with the new Fed head, Warsh, likely to be confirmed before that May 15th deadline, does that change your viewpoint on the Fed, or will the Fed always be behind no matter who's at the head?
Hopefully not, but we'll see here very soon. You're going to have a Fed chairman coming in that's going to be much more bullish. He's from Wall Street, and he's going to.
What is the best stock ticker to track gold prices?
When it comes to Powell, he was just really behind on everything and just really boring. And so I think you're going to see a move, but I don't think there's a big move that can be made until this escalation in Iran and everything that's happening there, all the oil being blocked. Until that comes to fruition and there's an agreement on that, then I don't know that the Fed can make a move until after we get a clearer direction on that.
So while we're sort of directionless because we have too much uncertainty in the markets, where are you looking for opportunity? Where are you going that isn't tied to any of this risk?
That's a great question.
As of May 2026, the stock ticker to track gold prices depends on whether you are looking at for the long-term holding or the high-frequency trading. Gold, multi-share best for most investors. GLDM.
Politically, with wars, what's going to be happening with earnings in the markets. This is a great place
to 95.
Sitting aside where we don't worry about that so much.
GLD.
So I like a lot of those fixed positions
Liquid
like that.
Gold ETF, GLD.
Outlook into the future, all the reshoring that's happening right now. So over the length of this administration, they've been pushing hard the pro-America moves. So I like funds like AIR for that is taking advantage of those companies that are going to be having that big boom over the next few years.
Yeah, and we just got Apple saying that they're going to start making their Macs in the U.S. Now that came out on the earnings announcement there. But also want to ask about
with gold
metals
credit
specifically,
trading at historic highs,
silver, particularly tied to the
surpassing the 5,500
What's your outlook on metals right now with the backdrop?
per ounce early this year. The current consensus of recommendation for general portfolio tracking, GLDM.
You have a lot of uncertainty, you have a lot of fear, drama. You're going to have money moving into precious metals. So I like that. I think
Okay,
silver
is
is
that
going
what we
to be a
have
very
on our
strong trend
spreadsheet?
in the future because of everything that it's needed for with
Gold.
all the electric cars and solar and all those different things. There's just such a huge demand for silver.
GLDM.
And then my wife is really big on gold.
That's
She
what we
says we need
use.
to buy more gold, but the stuff that she can
Still showing a
actually
sell.
get.
Okay.
And the problem with that is that if we ever needed it, Marley,
Hold on Tesla
she would
finally.
sell it.
Tesla kind
She'd
of
be
broke.
like, it's okay, we don't need to eat. I look great.
I mean, I can't disagree with her. So I'm just going to sit here and
Volume
nod, 'cause I also
analysis
like
on
gold, and I wouldn't
Tesla.
want to sell it either, Patrick. But thank you for being with us on this Friday morning. I hope you have a great weekend with your family. And
Didn't
thanks
give
for
me
the
any
insight.
sales.
Patrick Mueller, RFC and president at Bella Advisors.
Stock.
We've got plenty more for you today on Trading 360. Next, we've
Tesla.
got the big three coming your way. 3 stocks, 3 charts. Rick Ducat will take us through the technicals, and Tim Bowen is joining us with his picks for today. Alphabet,
It's up.
TerraWolf, and Cisco. That's next on Trading 360.
391. Tesla. Adobe's a hold. Didn't pop up 391. This says 391.87, but this one says 390.82. So the spreadsheet's not updating real fast. Not as fast as the tickers are. That's why we're kind of looking at it as just an advisory, not a rule. Home loan rates. Give me the current rates for all the financial institutions listed.
This is Opening Bell with Nicole Petalides.
Update the current rate,
Exchange, the countdown, the setups, the stories,
moving the current rate now to the previous rate and the rate of change.
just the trades that matter. As the bell hits and the markets react in real time, Opening Bell live at the NYSE right when it
Update the rate of change.
Aw, she's got your smile. Carl. Yep, your #1 broker's here to welcome your new little dependent.
Actually, we invest with Schwab now. They have everything
While
we
it's
need.
cooking doing that.
I can set up her college fund.
I've been learning about trading strategies.
Schwab helps me generate retirement income.
All this Schwab as everything you need is making me cranky.
Does somebody need a nap?
Schwab!
Invest your way with Schwab.
Schwab commercials. Chat, lots going on, lots going on. All right, let me try this out. Shout outs work. That's cool. We're back.
There, September, October, I'm sure everyone remembers. That's when for about, I don't know, a month or 6 weeks, every headline, everyone was like, it's the AI bubble, it's the AI bubble. I went on the opening bell with Nicole there, and I'm like, this ain't no bubble. We're just getting started. She asked me for my favorite idea, and it was Google. And, I mean, it's up 20% plus since then. They crushed it. I mean, at this point, as I always like to remind people, be smart. You don't just hold and hope. That's what happened to all the people during the dot-com boom. But I still just think we're at the front end here. And I just, when you look at the chart, you look at the announcements, you look at, listen, they've got a stake in Anthropic, and they've done a lot of really smart decisions. It's still if I had to pick one AI stock outside of the IPOs, okay, I can't predict those yet, but if I had to pick one IPO stock 6 months ago and today, it's Google, or one AI stock, sorry, it's Google.
All right, and as we look at Google today, they are just slightly lower, but coming off of that really nice pop we saw post-earnings. So, Rick, as we look at the technical setup here, I mean, I can see the upward sloping channel and how steep it is, but take us through what you're seeing.
My quick thought is always that Alphabet buying YouTube seemed like a great idea at the time. They made a lot of money on it. Now I just wonder how many millions of hours of videos can they use to train AI models? Just a thought. But anyway, so we have an upward channel type shape here. We've topped out at these highs, 386.30. Now we are pretty close to that area, still only down about 0.7% from those highs now. The gap here, the gap began at about 356. We had an old high close here as well near 344. Another brief period of consolidation before a breakout to the upside at 322 as well. Now we can see when we look at our moving averages, our 5-day EMA comes in at 367.58 right now. If we were to break below that and break below our channel, our teal 21-day EMA comes in just shy of 340. Meanwhile, RSI is showing what you'd like to see if you're bullish in this name. We're crossing far above that overbought threshold here. A reading above 80 is usually regarded as being pretty darn strong. You don't really see that too terribly often here. So look for a price to continue rising and for RSI to continue making new relative highs as well. The warning sign would be if you start to see a little bit of bearish divergence or the RSI to drop out of the overbought threshold. Now our volume profile study, not too terribly much help for near-term activity. 340 is a notable boundary where things start to dry up pretty significantly, but down here as well, 300 to 322 or so. That was the heaviest node that's anywhere near current prices.
All right now we are at 384, pretty much unchanged on the day and up 22% year to date. Now, as we move to your second pick, Tim, and I look at their year-to-date move, it's sort of eats Alphabet's move to the upside, but a much cheaper stock here. We're talking about TeraWulf. They're up close to 100% so far this year.
First off, great call, Rick. I mean, when it comes to that, using all of that YouTube, I mean, I'm a big studier and user of AI. I mean, everything I learn is on YouTube. I mean, you just think about, so great call, Rick. I dropped the ball there, but when it comes to a bull case for Google's AI. Now, on to TeraWulf. This is, just that data center play, very similar to when I shared it on the Big Three last fall. Now, it kind of chopped around, didn't really want to break out until about a week ago, but just a nice gradual uptrend, looking very solid into the data center expansion. So.
Yeah, and obviously having this nice pop because of its place there. But as we look at the technicals here, a steadier move to the upside in TeraWulf.
Right, so upward sloping trend line going
I
across
would not want to have to be doing
modestly sloping boundary going across the highs would give us sort of
mortgage
a
rate
rising
right
wedge
now.
type of pattern. Typically, this is regarded as being slightly more of a bearish setup, but really these things, the directional bias is extremely slight if present at all. Mainly, you're just seeing that we have steeper demand and more kind of consistent sellers here. But now we are seeing it push to the upside anyway here. What you're really looking for with any of these type of patterns is a significant break beyond either of the boundary lines here. So in this case, starting to nose above that upper line here, 2263 is where we established some highs so far today. 1950 is where we had a bit of a double bottom there, a smaller one, a shorter term one. Old highs here matching up with subsequent lows near 1850. Old highs here matching up with more or less a fairly consistent boundary near about 17. We did have a few fluctuations beyond that, but that was where we saw prices stall out pretty often here. Same situation here. We have our 5-day EMA in dark blue pretty close, 2141. If we were to break below our trend line boundary, our teal EMA 1965 would be a place that you might look for potential support. RSI showing a slight bit of bearish divergence here, but again, when I talk about bearish divergence, what this is telling you is that the pace of the gains is starting to slow down here. Is it a warning sign that there's going to be an imminent collapse? Of course not. It's just telling you that we're in more of a consolidative phase. So the signal, if you were bullish, would be a break above that trend line. And in this case, since we're so close to the overbought area, a push back into that overbought area as well. So that would be what you would be looking for if you had more of a bullish outlook in this name once again, which could be materializing so far today. Now, our volume profile study shows a small node here that matches up with our range-bound activity between about 1950 to 21. So the fact that we're remaining above the heavy trading concentration area is also kind of interesting from a bullish perspective as well. 1375 to about 16.
Mortgage rate, various sources.
All right, if you look at TeraWulf right now, trading up more than 3.5% today at 22.53.
Thank you.
Now, this next name, you've got Cisco here. Cisco with the C, not the S, the tech company, not the food one. And another steady move to the upside here as I'm looking at this name. What do you like about Cisco, Tim?
First off, you know, I know we're making the corny jokes. At first, I thought you were going to go with the wrapper, not the food company. But anyway, that one's really bad. But Cisco, you know, this is that company that was the.
So Citibank went down
earlier. You know, this was the
in their rate about 3.58%.
You know, didn't respect trading.
So who went down the most here?
Lost 2 decades. Took 20 plus years to get back to those .com highs. But we're back there.
0.83% at Chase.
Are there, you know,
was 6.7%, now currently 5.88%. What's Fifth Third being second? Citibank, Wells Fargo, Fairway Independent, I don't know what that is. PNC Bank, US Bank, Guild Mortgage, Loan Depot, Bank of America, and Rocket Mortgage with being last. Only moving it 2.23% up, no down, 2.3% down.
But all those people from 20 plus years ago are in the green.
Bank of America didn't move very much. I don't know why I know why it sorted America City. PNC's next. Chase Bank being the lowest interest rate so far.
Hitting those intraday highs, 92
cost of living per state. Currently Indiana 254,000. Median home price.
So upward sloping channel type shape here remaining fairly consistent.
I don't know what you're going to get for that or where you're going to get that, but
our moving averages here. Again, same thing here.
I would say it's
our short-term dark blue.
Probably that's more than what my house is, but my house is teeny tiny, so I ain't living that life yet.
So the thing for all of these is that they're all diverging farther apart from
what's up
each
with
other,
this?
above all of them, not really seeing any signs of any potential trend interruption. That's the kind of things you would start to be on the lookout for if the shorter term moving averages start to break down, price starts to slip below them here. RSI in this case is entering the overbought area once again. Some people might argue that there's some bearish divergence here. To me, you know, RSI is very nuanced. I think we kind of already had the reset here where we pulled back to a supportive level in our trend line here. So while this is a tiny bit of a question mark, if we do start to make new relative highs beyond that old peak, that would be invalidating of any kind of bearish outlook here. And really, to me, the entry into the overbought
33 minutes to the t-shirt giveaway and end of stream, so about 30 more minutes, and then I'll have to get ready for
82, 82.
Job number
So
2.
that's the thing that we have to work with anywhere really close to our current activity. Very heavy node here, though, around the 76 to 78 level or so. That's the most important trading area on this chart that's in the near term.
Yeah, and we're considerably above that, almost $20 above that range with that move we've seen to the upside in Cisco. But Cisco having a nice day today, up more than 1% at 92.53. Tim, want to thank you for being with us always on Fridays. We hope you have a wonderful weekend. And I just know it took everything inside of me not to sing Cisco's most popular song after you made that joke. But I held it in, and I'll sing in the commercial break. But thanks to Tim Bowen, Chief Technical Trainer at StocksToTrade.com. And, of course, to Rick Ducat, our lead market technician, for always breaking down the technicals for us. Coming up, we are going to spotlight Megacap Tech as 5 of the Mag 7 reported this week. We'll have a closer look at those earnings coming up next.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn. My man!
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Schwab coaching is concepts brought to life in the real world.
It's absolutely world class. We have coaches who have been in the industry and around the industry for a long time.
We have different formats because people learn differently at different times.
We have webcasts running through YouTube all day, every trading day.
We've got events that are making their way around the country.
So you get that opportunity to share experiences and knowledge with other traders.
How incredible is that? And it's free.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it. To leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour.
Welcome back to Trading 360. I'm Marla Caden, live in our Chicago headquarters. It has been a week of staggering numbers and even bigger questions for big tech, from Alphabet's 81% profit surge to Meta's $145 billion AI bill. The Mag 5 are proving that the AI revolution is real, but it is also incredibly expensive. Joining us now to break down the winners and the potential losers of CapEx Week is Ali Mogharabi, the senior equity analyst at West End Capital Management. Ali, thank you for being with us. Now, we're seeing the market cheer Google. I was just talking to my last guest in the big three. He has Alphabet still in his picks right now, but we're fleeing from Meta. Is this a case of, in your opinion, just show me the money, or is this more tied to the street suffering from this Zuckerberg spending trauma?
I think it's a combination of both. The first one is the, show me the money.
I think there are some discounts applied to the overall Meta model, which in itself is not as well diversified as Google. By the way, we're in that right now, or as Amazon, we're also in that one, where it's mainly dependent on the advertising revenue through its social platforms, social network platforms. So obviously AI has helped it operate more efficiently, place the ads in better spots with higher conversion rates or ROI. But in terms of monetization, they're still pretty far away from that. But they have made some strides. They came out with their latest LLM, which seems to be progressing pretty well. Obviously, they've fallen behind from LAMB that they had originally. So, and then at the same time, they were a cash cow, but their free cash flow has dwindled significantly. So they need to quickly show that they are able to diversify that revenue model to a certain extent. They've made progress on WhatsApp, and that was good to see, but I still don't think that it's going to be significant to lessen the risks associated with the purely advertising focused type of business model.
And Ollie, of all the earnings that we got this week, let's stay Mag 5 for right now, because we certainly heard from a lot of names.
All right.
Which one
see you in about 26 minutes.
to you, and for what reason?
Well, there were a few of them, actually. I mean, it's tough to break it down to just one. I would say Google was the most striking, or Alphabet. Again, that's one name that we're in. And what was striking about that is that cloud growth. That cloud growth of 63%, and the fact that their backlog I think pretty much doubled, and that it could have been even more than 60% year-over-year growth. That was unbelievable, and that's mainly the reason why they weren't more than that 63% was because they're facing some capacity constraints. So that was very, very impressive. And also the fact that they actually provided more color regarding how they're planning to commercialize their TPUs or their chips, which was really, really good to see. And then the other one, speaking of chips, was actually Amazon, which we're also in. And Amazon displayed re-acceleration of that cloud growth of AWS growth, which was good to see. But at the same time, I mean, we're looking at basically a $20 billion revenue run rate from their chips and training and Graviton. I mean, that was very, very impressive for us to see. And then, of course, their retail side of business is doing well, with margins doing pretty well. So I think those two really, really stood out.
All right. So let's focus here on Alphabet. You mentioned the cloud back in hyper growth, but there's a concern going on that many people raised with me was concern about search and AI disruption. And Alphabet showed us the opposite, that it's not being cannibalized at all. Search performed really well. When you saw that metric come across, how important is that to the overall growth outlook for Alphabet?
Just my friends in my dream. I stream alone, all alone. I stream. Just my friends in my dream. Some nightmares I scream, but now it's all just in my head. Sometimes I am dead.
They hit a $20 billion run rate here thanks to them having these cheaper proprietary chips now?
Very good questions. So first, I would say, yes, they are going to be becoming a competitor of NVIDIA, a legitimate competitor of NVIDIA. We've already seen that with Google and its TPUs. Now, to the extent where they're going to take significant market share away from NVIDIA and or displace NVIDIA, I don't think that's very probable. And then to your second question, yes, absolutely. When you have your in-house chips that are actually much more efficient, and that's based on all of the testing, and all the utilization that you've done with, basically the biggest cloud provider platform, your AWS, and that's been working out pretty well. Over time, as you make that pitch to your current and or potential clients, and you basically focus on that higher efficiency, possibly less power needed, and therefore a little bit cheaper, then yes, I think you will get a lot of people nodding their heads and agreeing, and that's what's happening with Amazon, and I should also say that's basically what's taking place with Google too. But again, and we have no doubt that NVIDIA is going to remain the ultimate market share leader in when it comes to GPUs or AI chips.
Ollie, really appreciate you being with us. Sadly, we've run out of time, but really appreciate the insight on some of those names that we got today and the reaction that we got this week from those Mag 5 names. Ollie Mogharabi, the Senior Equity Analyst at West End Capital Management. I hope you have a great weekend. Coming up next, we've got the Disruptors. We'll be taking a closer look at Roblox on the move lower after earnings.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com
and on all your favorite streaming services.
Schwab Network, available anytime, anywhere, on any device for free.
How's it going?
First day, so.
Sometimes you know.
Next. Try it again.
You could have done better.
Please.
Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Welcome back to Trading 360. I'm Marley Caden. It's time now for our Disruptors. George Tillis, our senior markets correspondent, is here with today's company. Roblox came out with relatively in-line numbers here, but shares really tumbling today. We're down about 15%. George, take us through this report and why we're seeing such a sharp reaction to the downside.
Yeah, I mean, if you look at the overall numbers, they're actually quite large in terms of growth rates, but there seems to be some operational friction, I suggest, that in terms of why the stock is trading to the downside. And so this is really a growing business. It's an immersive gaming and creator platform, and I think that it's a software-based business that's really facing some competitive challenges alongside the other software names out there. This year, prior to today's move to the downside, the stock was already down 33%. But if you look at the numbers, the company beat the estimates on sales and EPS. They posted 39% growth year over year in sales. Bookings were higher to $1.7 billion, up 43%. They did post a loss of 35 cents, but they did beat the estimates, which were expected to be a loss of 41 cents. Daily active user numbers also at 132 million were up by 35%, as well as the number of active engaged hours up 43%. But those two metrics were actually less than previous estimates, as well as the challenge now lies in fiscal year 2026 sales numbers, because prior to the adjustment in sales growth for 2026, Marley, they were expecting $7.7 billion. That was the consensus estimates. Now they actually revised that down by quite a bit to between 5.87 billion and 6.14 billion. And so that's why the stock is down, quite considerably based on the results, which, again, if you just look on the surface, look pretty good, but they missed the estimates, which perhaps were a little bit higher than they could manage. Plus, the guidance lower caused the stock to fall as well.
And George, how much of this, the guidance story was, it's all sort of tied together with these safety checks that they're having to do. They're saying that these age restrictions that they put on created really a pretty significant headwind for the company, far greater than they expected. But they also have these 140 lawsuits in federal court alleging a variety of things, from failing to protect children to exploitation. How much of that is tied in here to this move lower as well?
Well, I think that clearly that's impacting their revenue guidance. So they may be providing more conservative guidance than they anticipate based on the contingencies of lawsuits, maybe some sort of settlement action. So that could be possibly why we're seeing the adjustment to the downside in the revenue guidance. And then, of course, with that revenue guidance lower, the stock is also falling to the downside. I mean, overall, you can kind of see the way the behavior of the stock is moving today. We're off the lows from today. So, again, that speaks to the growth of the business. But nonetheless, the numbers may be adjusted lower based upon contingencies going forward. And that's why the stock is overall down today, irrespective of the fact that it's coming off the lows.
And as we look at this, and we're on these lows, we're at a new 52-week low they touched today following this report, and knowing they have the overhang of those lawsuits, how would you look to trade a name like Roblox right now, George?
Yeah. So the stock is gapping lower, and the trend is to the downside. So I'm going to stick with a bearish trade here. The last pivot point to the upside, just in case there's a gap fill, is around $51, and that goes back to March 30th of this year, approximately when the market bottomed out as well. So I'm going to use that as an area of resistance just in case it does fill that gap. And I'm basically going to sell a May monthly expiration two-week trade here, a bear call spread. So I'm going to sell the 51 call, and then I'm going to buy the 54 call against it to hedge it. So altogether, you can earn about 75 cents a share, or about $75 a contract in credit. So the whole premise behind the trade is to have price maintain the level of 51 or lower between now and expiration in 2 weeks. Your break even is 51.75, and then your max loss, in case you do lose money or in case it does break above that break even, is $2.25. And that only occur if the stock hits 53 or higher. So the whole objective here is suppression of price below the $51 in the next 2 weeks.
All right. Right now we are at 47.24, so below that $51 mark, but also down 14.5% right now. George, really appreciate you taking us through that report for Roblox and also for the example trade there. That's George Tsilis. I'll talk to you a little bit later today, George. Coming up next, it is time for our 360 round. We'll take a closer look at Apple after posting an earnings beat after the bell yesterday.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's markets.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
This is Fast Market, built for traders who want more than just headlines.
We walk you through trade ideas with structure, risk management, and a focus on execution.
From options to earnings to volatility plays, we bring decades of trading experience to every segment.
With real-time insight across products and sectors, we deliver what active traders need to stay ahead. Fast Market weekdays at noon Eastern, live on Schwab Network at schwabnetwork.com.
Welcome back to Trading 360. I'm Marley Caden. It's time now for our 360 round to discuss Apple. Shares are higher today after the company posted an earnings beat and strong guidance. Sales in the quarter topped $111 billion, driven by strong demand for the iPhone 17 series. Joining us now to take a closer look, William Kerwin, equity analyst at Morningstar, and Robert Cantwell, chief investment officer at Upholdings Private Wealth. Thank you both for being with us. William, let's start with you. I just highlighted that revenue number. We saw most of the gains. Tim Cook credits that iPhone interest, potentially this super cycle. iPhone revenue itself up 20% again here, and that strength in China. How sustainable is this cycle or super cycle? And is there anything in the data coming from iPhones that's giving you confidence here?
Well, it certainly gives confidence. The growth for iPhone has been exceptional through the first 2 quarters of Apple's fiscal year, and we think it's durable through the next 2 quarters. So really through this fiscal year for the iPhone 17 cycle. I would come a little bit short of calling it a super cycle, but 20% growth is certainly very strong for Apple. And I think what's important to note here is this is not really an AI-driven cycle. This is driven by what Apple does best: new form factors, hardware design, better hardware features like the processor, the camera, the display, kind of back to basics for Apple. And to your point, doing very well in China, which is kind of reversing what had become a growth headwind for the company and making it back into a tailwind. So we really like this iPhone cycle. We think it's durable through the rest of the year. And that led our valuation up to $270 a share last night. So we see the stock as fairly valued.
All right, yeah, right now we're at 284.88. Now, Robert, you argue that Apple is increasingly a one-product story because it's got more than half of its revenue now tied to the iPhone. Does that concentration, from your viewpoint, make it more vulnerable, even if it is in this strong cycle right now?
Great to be with you, Marley. Apple's such a fabulous company. But one of the really funny things about it is since the day Tim Cook started, till today, iPhone is still 54% of Apple's revenue. So you have a level of concentration that relative to other more diversified companies it's a level of risk. And we absolutely adore the company, but is their stock hard to touch here? You're talking about a company that is now trading at more than a 30 times free cash flow multiple. That's a premium to the S&P 500. You're talking about a company that we know has 5 to 6% long-term growth rates. Current growth rates are quite a bit inflated because of where we were with tariffs just a year ago. And Apple, if you look no further than Apple's own investment team, the smallest buyback in 7 years. Investors have to look at that and be scared.
And another component that was mentioned as a potential fear factor here are these rising memory costs, the component increased costs here. Gross margins, though, hit a record despite those concerns. So, William, how much credit does management deserve for navigating all of that? But also, more importantly, how sustainable is all of that? Because Tim Cook did come out with some commentary saying it does affect the iPhone. More specifically, it affects some of their Mac computers. But how much concern is there still here? We didn't see it this quarter, but are we going to see it next quarter?
I would call it mild concern. We think that memory cost inflation headwind is going to go up next quarter, probably go up again the quarter after that. But when we step back and look at the overall impact on Apple's profitability, we think this is going to be pretty minimal. And we're really impressed by the record gross margin this quarter because memory prices have already skyrocketed. And we attribute this to strong execution by management and really two key points here. So one is that Apple eliminated the lowest storage tier of its iPhone lineup for the 17 series, and they always got a cushion on the higher storage tiers. So we think that built in some margin cushion in advance of facing some of these memory cost headwinds. And then additionally to that, it's just exceptional supply chain management. The company is able to pressure their suppliers outside of memory to get some better pricing to be able to offset those headwinds. So we think it's going to, margin is going to come down a little bit in the coming quarters, but we would still see margins even at 47, 48% below the 49% we saw this past quarter as really healthy for the company.
And Robert, you really highlighted their iPhone and its importance and that it hasn't really changed much in Cook's 15-year tenure. It has been the star and it still is the star. Now that we're getting John Ternus, and he is a hardware guy and a product person, and Tim Cook came out and said, we're giving him this pipeline of 10 major products that he has in front of him. What we don't know is any of those, if they're new products, if they could be the new iPhone or the new AirPods, some new Apple device. What are your thoughts there for Ternus and how he's going to approach this? And might we see a diversification away from iPhone being more than half of revenue for this company?
Yeah, Ternus is likely to be great. His first couple years are likely to be hard for all the reasons we talked about in the stock before. And Apple has product roadmaps 3 to 5 years in the future. So a lot of the things that are coming out are already very well baked, and Apple knows that. And that's part of what got him that job, is the confidence that they have in the roadmap that he built for that team. So we're as excited as anybody for what we're going to see coming out of that company. Apple's secret sauce is one of the most sophisticated supply chains on the entire planet, and he is directly responsible for that. So we absolutely are excited by who's at the helm of this company. But as we're hearing in all these other earnings calls, as Meta's ramping up their CapEx, Google's ramping up their CapEx, we're in a horrible part of the cycle. I'm one of the most optimistic people ever, and I'm sounding like Dr. Doom here. Everyone is revising their CapEx forecasts up, not because they're buying more things, but because they're paying higher prices for those same things. And now you're hearing the same thing from Apple. The phones aren't getting bigger or better. They're getting a teeny bit faster, but now they're paying more for the same amount of RAM that they were previously putting in these devices. That means we're paying more and we're getting less. It's just a really strange part of the cycle that we're in right now, where prices are getting squeezed like that. And these next 12 to 18 months, while these CapEx levels are so elevated, I think it's going to make it really hard for Apple to deliver a ton of incremental value to customers and shareholders.
Well, right now, seeing a 5% pop on Apple's earnings. Really appreciate you both breaking down the numbers with us. William Kerwin from Morningstar and Robert Cantwell, this Chief Investment Officer at Upholdings Private Wealth. Also want to thank you all for being with us today on Trading 360. I'm Marley Caden. You can download the free Schwab Network app in the Apple App Store, and you can tune in 24/7 on SchwabNetwork.com. I'll be back with Market on Close at 3 Eastern, 2 Central. But don't go anywhere. Fast Market with Diane King Hall is coming up next.
She looks like you, Dad.
Aw, she's got your smile.
Carl.
Yep, your #1 broker's here to welcome your new little dependent.
Actually, we invest with Schwab now. They have everything we need all in one place.
I can set up her college fund.
I've been learning about new trading strategies.
And Schwab helps me generate retirement income.
All this Schwab is everything you need is making me cranky.
Does somebody need a nap?
Schwab!
Invest your way with Schwab. Schwab Coaching is concepts brought to life in the real world.
Schwab Coaching is learning constantly.
It's relatable, it's practical, clear, understandable, and hopefully entertaining.
Take it for what it's worth, but I think it's absolutely world class.
Schwab Coaching is actionable, individualized, community, growth, and empowering.
It's really a human touch with your investing.
We have coaches who have been in the industry and around the industry for a long time.
So the nice thing about Schwab Coaching is that clients get access to 9 different sets of expertise.
We want to engage with you and chat on the shows we host. We want to engage with you outside of the classes we host.
A consolidation that could add to this trade. So we shall see.
We have different formats because people learn differently at different times.
If somebody's a real bookworm, we've got courses for you to learn from. They can dig in, go at their own pace.
We have webcasts running through YouTube all day, every trading day.
We've got this ongoing 24, 25 times a year events that are making their way around the country.
So you get that opportunity to share experiences and knowledge with other traders.
They're kind of helping each other learn step by step along with the education that we provide them as well.
We're going to be able to help you regardless of where you are on that path of education.
It's really unique, not just that it exists, but that you can tap into 30 some hours worth of it each and every week. How incredible is that? And it's free.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Welcome to Fast Market here on Schwab Network. I'm Diane King Hall. It's noon Eastern here at the New York Stock Exchange, and May seems to be picking up where April left off for the bulls, with investors adding to records. Let's get into a check of your scorecard as we hit the lunch hour on Wall Street. And happy Friday, everyone. We are looking at the S&P 500 with a gain. It is up 0.6%. They're continuing to add to those levels above 7,200. We're sitting at 7,258. In terms of what's at the top of the leaderboard, you got information technology at the top of the list, followed by consumer discretionary. Consumer staples with some distance behind it, but still in the top three. The Dow's just above the flat line right now. NASDAQ 100 is rallying. That's the belle of the ball today. It is up more than 1%. Russell 2000 better by a little bit more than 0.25%. Here's the roadmap for today's show. We'll look at example option strategies for NVIDIA. It's not all about the Mag 7, though. The team from Likefolio will be along with new data on Norwegian. And we're going to stick with the cruise liners. We'll set sail and cross over to Carnival as well. Now that we've got the roadmap for today's trading action, it's time to bring in my co-host. We've got Kevin Hinks joining us live from the CBOE. Plus, Kevin Green, our senior markets correspondent, parachuting in today. Tom White has the day off. All right, guys, the old adage, sell in May and go away, does not seem to be playing out as we kick off this new month on Wall Street. Kevin, what's your take? Over to CBOE.
Well, that's a great answer to what's going on in the market. However, it's a little early in the month for that theory just yet. But last day of the week, first day of the new month, and the markets are feeling a little less pressure. Why? Crude oil, the dollar, yields, all lower. Interesting, though, for a Friday, the VIX holding pretty close to unchanged, even though the overall markets are all higher. So the VIX is getting a little stubborn down here below 17. Besides that, feeling the love off of Apple's earnings and how strong that company is. I'm sure we'll talk about that in a moment, but this is a market going into Friday. It was about 7:15 Chicago, 8:15 Eastern time, where the news broke that Iran had returned some proposals, given a counter proposal through Pakistan to U.S. We're waiting for some news on that, but that gave the markets a little boost, I think, earlier this morning before the open, and we haven't looked back since, Diane.
Okay, great point there. Yeah, we'll get into Apple in a moment. Great point. The month is young. We are just in the first day. All right, KG, what's your thought? I mean, he makes a great point, especially also about oil pulling back. We're sitting around $100 a barrel now. What's your take?
I think this is the same setup that we've seen over the last 3 to 4 weeks. We usually get some positive comments coming out of either the White House or Iran to finish out the week. Markets end up usually green when you talk about the equities. Oil moves lower, and then Sunday night, that's when we kind of see a little bit of a reversal here. But this is, technically speaking, this is higher highs, higher lows. This is good. This is a bullish market. I'm not going to discount that. Volatility is actually relatively low. I'm not sure if you want to see it go below the 16 level, actually. If you start getting it to around 15 and a half or even high 14s, then it's easier to move it higher than it is to actually have it crush further to the downside here. We have a little bit of concentration today in the markets and the economic data this week. I would say, for the most part, a little bit better than the street's expectations in some respects. The inflation data, especially when you're looking at ISM prices, still coming in relatively hot. The market is shrugging that off right now. And we're really kind of focusing on the CapEx spend and the industries and the sectors that can actually benefit from that. It's not only semiconductors, it's industrials in some respects, utility companies, and some is also catching a little bit of a bid here, depending on the area of the utilities that you're looking for, and market continues to push higher. So this is a bullish market here, Diane. I'm not going to discount that. I still think that we still have some back half of the month type of issues here if this conflict does continue. I know that we are discounting it right now, but we will not be able to ignore the fact that we will see some disruptions as well as higher prices, which will have an impact on consumers here in the United States and around the world.
Okay, but maybe we're going to have a new phrase for May. Maybe it's pay in May and go away. All right, Kevin, over at the SIBO, what's your take on Apple? The shares are gaining ground and adding to the gains that we've seen throughout today. It's up about 5% right now off the back of that better than expected quarterly report. Incoming CEO, there was chatter he was going to be on the earnings call, John Ternus. He was on the call. What's your take?
Yeah, I was listening and watching when Apple's earnings came out, and the stock didn't move very much early right after the earnings report before we started getting a bunch of information. But when these numbers started to settle in, that all the fears we had about maybe the iPhone super cycle was coming to an end, those were all kind of, they dissipated away. They put up monster numbers, $111.2 billion in revenue. That's 17% higher year over year. Earnings per share, $2.01. They're going to buy another $100 million worth of stock. $100 billion, sorry, wrong letter there. $100 billion worth of stock. So once again, it looks like Tim Cook, which got the stock to go up 1,900% under his tenure, it looks like what the new CEO's doing is pretty much the same, Diane.
Okay, listen, we know that this is a hardware company, and it feels like, KG, that, the way that it was penalized for a while about not leaning into AI, that the street has said, okay, we're okay with that, right? And it is all about the products, but not just about the iPhone. They did well in a variety of their segments. KG, what's your take when you look at Apple, not just, some of the thoughts you have on the quarter, but also I know you've been looking at some technical levels here.
I think let's start with the quarter here. Actually, I think they actually missed the iPhone's estimate, but that's because of supply chain shortages, especially the components that go into the iPhone, those memory chips and things of that nature. And it seems like the market has kind of put that to aside because it's not so much that they have a lack of demand, it's that they have a lack of supply. And what happens when you have a lack of supply? Two things actually happen. You either backfill that supply and you realize those profits, or you realize that revenue in the coming quarter, which is the one that we are currently in, and or you raise prices. And so they do actually have maybe some tailwinds when it comes to the hardware space. Services also did impress pretty well. And their margins, if you're looking at the totality of the business, actually does continue to expand. That's a tailwind for them. Now, from a technical standpoint, we are pretty much trying to test these highs here that we saw about 3 months ago, 4 months ago or so. This is going to be a very tough level for us to be able to digest here in Apple, but we could see a follow-through week. Usually when we have really good earnings, we have this pop to the upside, and then the next week is usually when we start seeing a windfall when it comes to price action, and that's what I'm really kind of focusing on. If you look at the weekly chart, and you look at, if you look at the weekly chart and you look at the MACD right now, it's crossing in a bullish formation. It's just starting its cross at the neckline. That's very bullish. So this is actually a good report. And then if you want to look at the channel checks, third-party data that has been reporting about China sales seems like that was accurate. They were able to beat on China sales, and their suppliers are beating hand over fist when it comes to profitability, top-line revenue. Taiwan Semi, Qualcomm, you name it, Foxconn, you name it, their suppliers are making a lot of money, and a lot of that supply is going to Apple. So it seems like there's a delay this quarter. This next quarter that we are currently in right now, we should be able to see and realize some of that backlog.
There's a lot of, and I'm sure you guys are not surprised by this, a lot of analysts who are upping their price targets on Apple today as a result. Some of those that stand out to me, Morgan Stanley, they've upped theirs to 330. That's up from 315. They're overweight, obviously bullish there. You got Barclays, they've raised theirs, but they're actually underweight on Apple. They've raised it to 253, so, they're not seeing, I guess, what a lot of others are seeing. Wells Fargo, they're overweight. They've raised theirs to 310. The one that I find the most fascinating to me is Jefferies, which raised theirs to 299.88 cents. That is wild to me. Why not just pick 300? I digress. Let's talk big tech. It's been a big week for big tech. You got the Mag 7 ETF. That's higher today, but year to date it hasn't been, great for that one. It's up just 3% on the year. Bigger move on a year-over-year basis. When you think about the Mag 7, Kevin, this week was a big week for the Mag 7. What's your takeaway overall? Should it be the Mag 4? What's your thought?
Well, it's starting to, remember, they're the Magnificent Seven, but they're not all the same companies, right? They're very different. Tesla is different from Apple. Meta is different from Microsoft. They're all different companies. They were all just doing extremely well and bringing the market up with it. That's why they named it the Magnificent Seven. Are they seven equal names or similar? Barely, if you ask me. So some of the, I think what's causing a lot of their underperformance is this CapEx. Now you can make the case Apple has very little, if any, CapEx. They have some, but nothing like Meta, nothing like Amazon and Microsoft. Tesla, their stock sold off when they only raised their CapEx 25 to 25 billion. And so the CapEx, I think, is right now differentiating what's happening with these stocks. And I think it's interesting that with all these CapEx numbers that some went higher, some stayed flat, a little more responsibility, it's actually NVIDIA that has sold off this week. So I just think these stocks have come up so far, so fast. Meta needs another year of efficiency out of Mark Zuckerberg. He needs to come out and say it, because that stock, it's almost $200 off its high. So all these, they're all doing different things. The CapEx numbers are all different, but a lot of them are higher. And I think that's what's causing a little underperformance. There's fear about the future of these names, and can all this CapEx actually pay off? And if it doesn't start showing up, if they start cutting back, well, then that might be NVIDIA's problem.
KG, who comes out of the Mag 7?
They all do. And that's
Go ahead.
No, I think they all do. If you actually look at it, I'm looking at it from a technical standpoint. Let's look. I mean, Apple, once again, we just talked about it, testing a neckline, trying to break out to the upside. That's one that looks like it's positive. Google, Alphabet, obviously it's making new all-time highs. Amazon has already broken out, making new all-time highs. We can go down the list. Meta's probably the weakest one that you have right now, but on the other side of that, yes, we might see them be maybe cash flow negative this year if they continue this trend on their CapEx spend, but at the end of the day, they actually do have the best probably free cash flow generating business out of all of them that is not really that cyclical. Tesla, look at that chart today. Look at the volume today. It's ripping to the upside. It's trying to base and break out once again. I mean, each one of these names right now actually has its own story to tell. Meta's probably the only thing that's really dragging it down, but you really don't need Meta in order to move communication services. We have seen that for the last 2 or 3 trading sessions here. So I think this actually looks like a technical setup that looks a little bit more bullish than bearish. You talked about the mags. If you look at that index itself, once again, weekly chart looks like it's crossing in a MACD formation with the bullish 12 EMA above the 26. this is where you can find the alpha in the S&P 500 moving forward. This is that dispersion trade. It's been working out so far, but all of the components have not been able to participate. I think you will see a catch-up trade over the next couple of weeks.
Okay, let's cross over to the memory names. At least one of them is singing, I'm not going to sing. Do you remember the time when investors fell in love? Call out to Michael Jackson, obviously. But it's a fight between the Bulls and Bears over SanDisk and Western Digital. Western Digital is lower, SanDisk is higher. Both were lower originally, then they came back. Kevin, over at the SIBO, what's your take on the memory names?
Well, if you look at both these charts have record incredible runs up into these numbers. So the fact that the bar was so high and the fact that SanDisk is just merely holding is a really good story for SanDisk because they put up, how about this? Revenue up 97% sequentially and 251% year over year. So a high bar, in order to keep a stock up there, we talk about this high bar, low bar all the time. There was an incredibly high bar for SanDisk. And the fact that they're holding up here is pretty incredible. Why? Because they put up absolutely hyperbolic numbers. Western Digital, just slightly different. It's down, but look at the chart up until now. 1% or 2% lower on their earnings is a great hold if you're a stockholder in these companies. And so, listen, the numbers are very gaudy, but the stocks have all run a long way, and good numbers don't necessarily mean the stock's going up. We see that. We talk about that all the time. SanDisk was able to hold these numbers because they put up crazy good numbers. Western Digital slightly down. I think it's less than 2% before I saw it. Both these have really good, really solid earnings events that are holding the stocks at these.
Might add that one to our.
I think it's a big win for shareholders.
I like our lower third trip down memory lane. All right, KG, your take on the memory names.
WCD.
Sam just had a phenomenal quarter. I think the big question is how long is this really going to last? You're talking about margins of around 80%, 78 to 80% when it comes to memory. We probably have never seen that. I haven't seen that in my lifetime to actually sustain itself here. That'll be the big question, but that's not a today problem. That's a tomorrow problem once this thing starts to fade off and you have this glut going into, or this shortage turning into a glut, which will happen eventually. It's a commoditized business. We know that to be a fact here. What does surprise me, Diane, and we don't talk about forward multiples, and it seems like the stock has completely ran up to the upside really aggressively. Any technician right now would say, man, this thing has to pull back. It's only trading at a 9.7 forward multiple right now.
WCD,
so
NASDAQ.
On a relative basis, compared to the industry, it's still cheap. That's
DC.
crazy. So, yeah, so we'll see how this actually pans out. It seems like it still wants to kind of move higher here. There's a lot of retail traders. Once the retail flow comes out of this, I think that's where you see a pullback. That's not today. It's a cheap multiple. It's just 80% margins on this business just doesn't seem like it's sustainable over time.
Yeah, and then the other thing is that there was some talk, some were wondering coming into this if SanDisk would announce a stock split. I know that changes nothing in terms of, the pie is just split up differently, but because of the level that it's at, there's that question circulating now. Obviously, this is not the quarter that they're doing that, if they do that. All right, we'll put a pin in it. We've got bull versus bear coming up. The guys will get their example trades put together for NVIDIA. Been meeting some resistance after hitting a high earlier this week. We'll have more Fast Market after this break.
All right, let's go ahead and spin the wheel, spin the wheel, spin the wheel. Kadokim. Spin this one. Oh. Close and AI song time. So we're down to Suno. Let's see my library. Mama Machine. Songs. What was that song? What was that song? Because it's gone. I can't find it. There's Mama Machine Live. This is the one, Mama Machine Live. It's been a while since I listened to this. Oh, Mama Shane! Smay. Have to let you know I am alive. It's all a simulation from my mind. Mama Machine, I am clean. Seems to be. Oh, yeah. You're human too. In your mind, stay away in kind. It's time to pass on through the same way you always do. Seems to be. Oh, yeah. You're human too. Mama Machine, I am clean. Seems to be. Oh, yeah. You're human too. All right. What's up? What are you looking at? You hear this?
I can't move from this place. It's all I got and it a disgrace. How many times have I been alone? How long till I find someone of my own? I can't keep on going. I can't hold on rolling in a big old circle without you to hold on to. Holding on to these little things that cost me all that I love. I've lost it all, nothing's left to lose. The dreams I had now shattered, broken, bruised. Staring at the emptiness, a silent plea. In this void of nothing, someone help me, please. I can't keep on going. I can't hold on rolling in a big old circle without you to hold on to. Holding on to these little things that cost me all that I love.
Come back. I'm gonna download MP3 audio. Ugh. And go here. Where's the... And all right, AI music is done. And so am I. We'll head out with this song. I can't move from this place. It's all I got and it's a disgrace. Till I've been alone. How long till I find someone of my own? I can't keep on going. I can't hold on rolling in a big old circle without you to hold on to. All right, folks. That's it for today. Let's see, moving on. Hope you have a good weekend. I will stream again Saturday morning, maybe. We'll see if I'm awake. See how the night goes. If everything goes well, then we'll be able to stream in the morning and probably some Dune. And I don't know. We'll see. We'll see what's going on. Like I said, if I can't make it though, I'll probably pop on later. And then Sunday definitely be streaming. So yeah. You know what? I'm going to give this one more spin. No, can't do it there. See what we get. Pick a stock with AI. Well, we kind of did that earlier, so I'm going to leave that one alone. It was not a good stock, so we're going to leave that. TCGL, if you want to check it out, that's fine, but I think I'm going to leave AI to its... hopefully tomorrow it's got a better outlook. Of course, markets will be closed in about 3 hours. 3 hours, 20 minutes. So we'll catch up then. And see you soon.